Assalamu alaikum. Welcome to my IFRS revision series. So, in this series, there are total 36 videos. That means 36 different standards. All the IFRS standards will be covered in this revision series. It's like a, you can say, a crash course for all your IFRS. And this is for all your financial reporting and SBR students, and also for the students of diploma who wants to get a quick knowledge of all the IFRS who are doing diploma in IFRS. This video is a very good start. So you can get all my videos under my IFRS revision crash course playlist, and to get all the slides you have to email me so that I can share the details about the payment for the slides. Now starting with IFRS S1. So IFRS S1 is about the disclosure of sustainability related financial information. This standard has been introduced newly. There are two standards that deals with sustainability. That one is IFRS S1, and the next video will talk about IFRS S2. For financial reporting, the FR students, only IFRS S1 is relevant. But for SBR, you need both S1 and S2. But I have included everything as I told you before. This can be used for any IFRS students who wants the knowledge of all these standards. It is not just that what will be covered in financial reporting I've covered. I've tried to include all the IFRS, okay? Wherever it is relevant for a subject, I will let you know. So IFRS S1 is relevant for both SBR students and FR students. So in this lecture, IFRS S1 requires disclosure about significant sustainability risks and opportunities. The information should be prepared for the same period as your financial statement. These are the disclosures that are required. There are four areas you require disclosure. First is governance. The process, the control, the procedure that are used to manage the sustainability risks and opportunities. This includes identifying the individuals responsible for identifying, assessing, managing risk and opportunities, management's roles in this area. So basically it's about your controls, the process and the procedure that you use to manage your risks and opportunities. Okay. Next is strategy. The company's risks and related opportunities, the impact on your business model, decision making and financial position, performance, cash flow, resilience of the company to this risk. Detail should be provided of the time horizon, whether it's a medium, short or long term. Okay, over the which the risk could have a financial impact and how the issues may affect the financial statements over time. Next, risk management. How the company assess the likelihood and the impact of sustainability related risk, how the company prioritizes this risk, the input parameters considered during the risk assessment, for example, source of data, whether the process is consistent with the prior years, how the company assess, prioritize, monitor, manage, and mitigate sustainability related opportunities. Next and the last is metrics and target. How the company will measure, monitor, and manage their risks and opportunities. The targets that are set, whether the measurement is validated or assured by an external party. So that's it. Remember, this is not to say this is not a substitute for your detailed knowledge of IFRS S1. You still need at the end of the day the detailed knowledge of IFRS S1, which I have covered in my SBR as well as financial reporting lectures. All you need to go is go back to my SBR lectures and financial reporting lecture playlist, and you can get the detail of IFRS S1. This is just a quick short revision so that you get the quick knowledge of IFRS S1 within a short period of time. So thank you for watching, and the next lecture is IFRS S2. Assalamu alaikum. Welcome to video 2, the IFRS S2. IFRS S2 is climate related disclosure. So in this, IFRS S2 requires disclosures about climate related risks and opportunities. So specifically they have mentioned it's about climate. Now, Here also we have the four areas that we have covered in IFRS S1: governance, risk management, strategy, and metrics and target. So under governance, as for IFRS S1, that means this disclosure also according to IFRS S1, but it is relating to climate related risks and opportunities. Coming to strategy, this is also as per IFRS S1, but relating to climate related risks and opportunities. So you see there's a connection between IFRS S1 and S2. You have to study them together. But let me tell you, IFRS S2 is not relevant for financial reporting students. It is only relevant for SBR students. Now, IFRS S2 requires the following disclosure about the climate related risks and opportunities. So risk management, the likelihood and the magnitude of climate related risk, how company prioritizes this risk, the input parameter for risk assessment, process, whether the process is consistent with prior years, how company identifies, assess, prioritize, and monitor the climate related opportunities. Just change the word from sustainability to climate related. That's it. Everything else remains the same as S1. Now, the extent to which the process described above are integrated into the overall risk management, and metrics and target. How the company will measure, monitor, and manage climate related risk and opportunity. Targets and opportunities that are set, objective of the target, the period over which the target will applies, progress made towards the target, and any targets that are required by law or regulation. Whether the measurement is validated and assured by an external party. So these are some climate related metrics and targets. This is not there under IFRS S1. They are greenhouse gas emissions. So you can look at the greenhouse gas emissions, which can be classified as scope 1, 2, and 3 emission, including the approach to measure those emissions, the reason why that approach has been chosen, and any changes in your measurement approach during the reporting period you have to disclose. Climate related transition risk, amount, the percentage of asset or business activities that are vulnerable to climate related transition risk. For example, cost of moving towards more sustainable working practice. See, this you don't have to do any changes in your accounting, measurement, recognition. IFRS S1 and S2 is only about disclosure. So you just disclose, disclose, disclose. Okay. Next, climate related physical risk, the percentage and the amount of assets that are vulnerable to climate related risk. For example, rising sea level, increased frequency of devastating storms. This can have an impact, especially on construction industry. Some industry like service industry will not be so impacted by the rise in sea level. But if you are having a factory nearby the sea, ocean or a beach, let's say, you are very vulnerable. Okay. Next, climate related opportunities. The amount and the percentage of assets or business activities that are aligned with your climate related opportunities. Then capital deployment. Amount of capital expenditure, financing or investment towards climate related risks and opportunity. Then internal carbon prices. An explanation of whether and how the company is applying their carbon price in decision making. And the price per ton of GHG that are used to assess the cost of GHG. What is GHG? Greenhouse gas. Remuneration. Description of whether and how the climate related consideration are factored into their remuneration and the percentage of the executive remuneration recognized in the current period that are linked to the climate related consideration. So now you will link your remuneration with the climate related consideration. Thank you for watching, and I shall see you in the next video. The next standard is IFRS 18. Assalamu alaikum. Welcome to video 3, IFRS 18 presentation and disclosure in financial statement. Along with IFRS S1 and 2, this is also a new standard that has been introduced. It replaced the previously IS1 standard. So in this, we are going to go through IFRS 18 replaces IS1, and it will impact every reporting entity that currently uses IFRS. It is effective for the reporting period beginning on or after 1st Jan 2027. Early application is permitted and it will be applied retrospectively. If an entity applies IFRS 18 earlier, they are required to disclose that fact in the notes. The amendments to IS 7, that is your statement of cash flow, and IS 33, that is earnings per share, as well as the revised IS 7 and IFRS 7. IS 7 also, the name has been changed, but the content remains the same. That is accounting policies, accounting estimates, and prior period error. And IFRS 7, that is the financial instrument disclosure, became effective when the entity applied IFRS 18. Now, the new categories in your statement of profit and loss. This is the main body in your IFRS 18 that you have to remember. There are 5. Your income and expenses are now classified into 5 categories: operating, investing, financing, income tax, and discontinued operation. So, let us understand these 5 categories in detail before I show you the pro forma of statement of profit and loss. Investing category. Your investing category has income and expenses from investments in associates, joint ventures, and unconsolidated subsidiaries. Let me tell you, before you reach to this stage, make sure that you watch my detailed video on IFRS 18 if you want the detailed explanation of this. It is there in my lecture 3 under my financial reporting lecture, IFRS 18. Now, but if you don't have time, and if your time is short, but it's okay, you can watch this. This also will give you a brief understanding of what exactly in IFRS 18 the main things are. But yes, once again, you have to do questions where you have to categorize income and expenses in this 5 category. Now, coming back to the topic, investments in associate, joint ventures, and unconsolidated subsidiary, cash and cash equivalent, other assets that generate return individually and largely independent from the company's other resource. Examples of income and expense that are classified in investing: share of profit of associates and joint ventures using equity method, interest revenue from debt investments and dividends from equity investments, rental income and fair value gain or loss from investment properties. Now, under financing category involves only those income and expense that only arises because you are raising finance. For example, return of your cash or company's own share, debt instruments that will be settled in cash, bank loans, interest and expense, the effect of the changes in the interest rates from other liabilities, lease liability, defined benefit pension liability will also come under financing. Now, operating category, the main thing, this is from your entity's main business activity. Not classified in other categories. It is very volatile and unusual income and expense will come in the operating category. Income tax category, only one expense, that is your income tax that you will use according to IS 12 and any related foreign exchange difference. Then we have discontinued operation, the last category, all income and expense that arise from discontinued operation according to IFRS 5. Now, what are the required subtotals in your statement of profit and loss? These are the new required subtotals. Okay, there are 3. First, operating profit or loss before financing and income tax, and profit or loss. So now let us go through the pro forma. This is how your pro forma looks. Because the pro forma is too big to fit on one single screen, I have included in 2 different slides. This slide will only include all the operating income and expense and other 4 categories: investing, financing, income tax, and discontinued, and the next slide. But it is the continuation of this. Okay. So first is revenue, deduct cost of sales, get gross profit, add other operating income. Then you deduct selling expense, research and development, general and admin, goodwill impairment loss, other operating expense, and get your operating profit. This section is known as operating. All these expenses that comes after gross profit, even cost of sales, are included in your operating category. After operating profit, okay, share of profit from associate, joint venture, and gain on disposal of your associates and joint ventures are your investing category. Next, then you get your second subtotal, profit before financing. And see, first you got your profit, okay, operating profit. Next, profit before financing and income tax. Then your interest expense on borrowing, lease liability, on pension liability and provision, all this interest expense are in your financing category. Then we have profit before income tax, where we deduct income tax, which is income tax category. Then profit from continuing operation. After that, one single line, loss or profit from discontinued operation. Mostly it is loss, that's why we are discontinuing it, right? So we take it, and that is your discontinued operation, and finally we get the profit, or it could be loss also. Okay, so this is the pro forma for statement of profit and loss according to IFRS 18. Now, specified main business activity. Some companies such as banks and investment property company will classify their income and expense in their operating category that other companies would classify in investing or financing. Because for bank, their main business activities were lending, loan, receiving, lending, right? Giving, borrowing to others. That is their main business activity. So for them, borrowing is not will not come under investing or financing. For them, it will come under operating. But for your exam purpose, your main business activity will not be in banks or investing. You should always take it as investing or financing category only. Okay. So this will allow such entities to report their key performance metrics within the operating section. Now, disclosures about management defined performance measures. This is relevant for SBR students, not FR students. This part, this section of IFRS 18. What is a management performance measure? An MPM is a subtotal of income and expense used in public communication outside financial statement, not listed in IFRS 18 or specifically required by any IFRS standard. Examples of MPM. Remember, you will be tested on this in your SBR. Adjusted profit or loss, adjusted operating profit, adjusted earnings before interest, tax, depreciation, amortization. They are not required under any IFRS standard, nor they are listed in IFRS 18. Okay. Examples of subtotals that are not MPS are your gross profit and profit before income tax, which are required by IFRS 18. Now, other financial and non-financial measure that are not subtotals of income and expense, and they are not therefore not MPMs also. Free cash flow, return on equity, net debt or EBITDA. EBITDA means earnings before interest, tax, depreciation, amortization. Adjusted revenue. See, these are not subtotals of your income and expense. Okay, they are not your management performance measures also. You have to remember this. And number of subscribers, customer satisfaction score. Next, MPM disclosure. It's a single note to a financial statement that includes a statement that MPM reflects the management's view of an aspect of the company's financial performance, an explanation of why that MPM is reported, an explanation of how it is calculated, a reconciliation with an IFRS defined number, a description of how company determined the income tax effect, explanation of any changes to MPM. The key point to remember is that if the measure is not a subtotal of your income and expense, or it is not used in public communication, then it is not an MPM. And therefore, the disclosure requirements for MPMs are not applicable. But if it's an MPM, if it's a subtotal of income and expense, it's an MPM, then you require disclosure. Otherwise, no disclosure is required. Enhanced requirement on aggregation and disaggregation. IFRS 18 has guided you whether information in your primary financial statements or the notes should be aggregated or disaggregated. Okay. Especially when you're presenting your operating expenses. So, how can you present your operating expenses? There are two ways, either by function or by nature. Okay. So, if you are presenting by the nature, for example, raw material expense, employee benefit expense, or function of the expense, for example, cost of sales, companies are permitted to present some line items in the operating category by nature and others by function that they are allowed to do. Some expense they will show by nature, for example, goodwill impairment loss, and some by function. In deciding how to present the operating expense, a company will consider factors such as what line items will provide the most useful information about their main components or drivers of the profitability and industry practice. They will see what is the industry practice, how do they report their operating expense, whether by nature or function, or whether they feel if they report by nature, their users are going to get a better information, or by function. So these are some factors that they will see before they present operating expense. Now, disclosure of expense by nature. A company that presents operating expense that are classified by function Okay, you have to disclose the amount for the 5 specified expense by nature. Remember, if you are presenting by function, you have to disclose under the note how it will be classified by nature. So the expenses that are disclosed are depreciation, amortization, employee benefits, impairment loss, reversal of impairment loss, and write down and reversal of write down of inventories. This you have to disclose because these are by nature. Because sometimes what happens when you present by function, you don't know what is the expense of depreciation by looking at the function. That depreciation expense is inside some other category or employee benefit like that. So in order to get this, you need by nature. So how will you get it? You can't present by two category. Write it in the notes. Okay. Now, thank you for watching, and I shall see you in the next video. The next video is on IS2. Assalamu alaikum. Welcome to video 4. This is on IS2 inventories. This is relevant for both FR and SBR students. So here, inventory should be valued at the lower of cost and net realizable value. Net realizable value is your selling price minus your cost which are incurred to make the sale. IS2 says that the cost of inventory includes purchase price, import duties, transport, handling cost. You have to add all. Direct production, labor, example, direct labor. This also is an addition to your cost of inventory. Direct expense and subcontracted work. Production overhead based on the normal levels of activity. Other overheads if they are necessary to bring the product or service to its present location and condition. So this 5 you have to add and they are taken as cost of inventory. These are the costs which are not taken as cost of inventory. They are abnormal waste, storage cost, indirect admin overhead, and selling cost. They are not your inventory, cost of inventory. Now, some entities can identify the individual unit of inventory. So, for example, vehicles can be identified by a number, chassis number. Entities that cannot do this, they should keep a track of the cost using either FIFO, first in, first out, or AFCO, weighted average cost. Some entities may use a standard costing for inventory valuation. Okay, standard cost may be used for convenience if it is a close approximation to your actual cost and it is regularly reviewed and revised. But in your exam, FR and SBR, mostly it is FIFO and AFCO that you will be asked. So you have to know how to do inventory valuation using FIFO and AFCO. This I have introduced in my IS2 lectures. So make sure that you watch my IS2 lectures. Now, example. Inventory has a cost of 200 and it is sold to a customer for 220 with the cost undertaken 30. Okay, so the rectification work cost is 30. So first the cost is 200. Your net realizable value will be amount that you have sold 220 minus the cost that you have undertaken 30. So 220 minus 30 is 190, which is less than the cost 200. So your inventory will be valued at net realizable value of 190. That's it. And exam questions, this is for SBR students. So in your from your revision kit, you have to do questions fill and lucky dairy for your IS2. Thank you for watching and I shall see you in the next standard. Next standard is IS7. Assalamu alaikum. Welcome to video 5. This is IS7 statement of cash flow. And this is relevant for both SBR and FR students. So IS7 requires the statement of cash flow that shows cash flow generated from operating, investing, and financing activity. So basically in IS7, you have to classify the cash inflow and outflow in the right categories. And both in SBR and in financial reporting, you will never be asked to prepare a full cash flow statement, but you will be asked to prepare extracts. In financial reporting, it is for single company, and for SBR students, you will be told to prepare extracts for consolidated statement of cash flow, the extracts. So following the amendment by IFRS 18, all entities are required to use the operating profit subtotal as the starting point for indirect method of reporting cash flow from operating activity. You have to start your cash flow by this. Okay, your new subtotal will be the operating profit. Okay, and you will be told, even though there are two methods, but it's always very common that you are asked the indirect method. This is for both SBR and FR students in your exam. Okay, and this is the oldest standard which is following cash flow basis. Oldest standard, because all the other standards, if you see, they are going by accrual basis concept. Okay, so the exam kit questions, this is for SBR students. You have to do sugar, moist and yogurt. Thank you for watching, and I shall see you in the next standard. The next standard is IS 8. Okay. Assalamu alaikum. Welcome to video 6. This is IS 8, basis of preparation of financial statement. Now this standard, the title of this standard changed, and also there are some portion that is added under IS 8, but overall the major content of the IS 8, that is accounting policy, estimates and error, is still there in this IS 8. It remains there, and the way we account for that is also same. So let us go through IS 8. IS 8 covers selection of accounting policy, changes in accounting policy, changes in accounting estimate, and correction of your prior period error. Now, first let's deal with accounting policies. Accounting policies are principles, conventions, your rules in applying and that is applied by an entity in preparing and presenting financial statement. For example, you have an accounting policy to go by cost model or fair value model. That's an accounting policy under IS 16, IS 38, IS 48. Now, when we change the accounting policy, we have to deal with it according to IS 8. Okay. Now, accounting policies, usually it should remain same from period to period, so that there is a consistent treatment and it is easier to compare. But sometimes there should be a change in accounting policy when changing so is giving more relevant and reliable information. For example, under IS 16 now you want to change from cost to fair value model. That's a change in accounting policy. Okay, whenever a change in accounting policy takes place, you will deal with it retrospectively. Retrospectively means you will change your current reporting and you will go back and change the previous period also. So what should you do? You have to restate your opening balance on your retained earnings as if the new policy has always been applied. Okay, and the resulting change in your retained earnings brought forward will be shown as a prior period adjustment under the statement of changes in equity. And your comparatives also will be restated using the new policy. Okay, so that means comparative also you have to change under the new policy. This is for change in accounting policy. Okay, and the change and its effect has to be described in the notes. Coming to estimates. Estimates such as depreciation rate, they are recognized in the statement of profit and loss in the same period as the change. So if the change is material, you have to disclose it as a note in the financial statement. Accounting estimates you deal prospectively. That means you change the current period and you go forward and change the future years. Unlike policy where you have to go back and change retrospectively. Accounting estimates prospectively. Coming to the prior period error. Error means if you omit or misstate your financial statement for one or more periods, okay, or misuse of reliable information. That's an error. So now you have to correct the error. How are you going to deal with the error? By restating the opening balance of assets, liability and equity as if the error had never occurred. This is same like change in accounting policy. So you are dealing with error and accounting policy in the same way, retrospectively. Go back and change asset, liability, equity. And also present the necessary adjustments to the opening balance of the retained earnings in your statement of changes in equity. You have to restate your comparative figure as if the error have never been occurred. And this adjustments you have to disclose as a note. So in short, prior period error when you correct and accounting policy when you change are dealt in the same way. The only exception is accounting estimates. Okay, mostly in your exam, both SBR and FR exam, they do not give you a calculation based question. They normally give you it as a part of another standard, maybe IS 16. They are saying now they changing from cost to fair value. So how are you going to deal with it? Of course, the valuation recognition you will deal according to IAS 16, but to say that it's a change in accounting policy, you will deal it retrospectively. You have to use the knowledge of IAS 8. Okay, mostly it's a written, you have to write about it. And thank you for watching, and I shall see you in the next lecture. Sorry, it's not a lecture, it's a revision series, that is IAS 10. So see you in the next video. Assalamu alaikum. Welcome to video 7 IAS 10, events after the reporting period. So here we are going to go through the definition of events after the reporting period. These are those events, could be favorable, could be unfavorable, which occurs between your statement of financial position date and the date when your financial statements are authorized for issue. Okay, there are two types of event. One is adjusting event, one is non-adjusting event. If it's an adjusting event, you have to adjust in the financial statements, and if it's non-adjusting event, you just have to disclose it if it's material. But how do you differentiate an adjusting event and non-adjusting event? See, in your exam, the key is to identify whether an event is adjusting or non-adjusting. Adjusting event means at the reporting date you will be having some evidence. Okay, so the evidence of condition will be existing at the reporting date. Events might occur after the reporting period, but there was some evidence that that condition could occur at the reporting date. One is litigation cases that is going on. Okay, so the case could go in your favor or against your favor after the reporting period, but that litigation was going on at the reporting date, it was there, evidence was there. So it's an adjusting event. Next, non-adjusting event. These are those where on the reporting date you have no idea. For example, a fire occurred, a tsunami occurred. At the reporting date, there were no such evidence that this event could occur. So these are non-adjusting. There were no evidence of that. Now, what is the accounting treatment? Adjusting event, as the word says, adjusting, adjust in the statement of financial position. Non-adjusting, as the word says, do not adjust them. Okay. But if the event is material, then you have to disclose the nature as well as its financial effect has to be disclosed. Now, example 1. So let us see this example and see whether it's adjusting or non-adjusting. It's about a legal provision of 5,000 included in the financial statement in 31st December 2004. In Jan 2005, legal case is settled, resulting in actual cost of 7,500. It's more. This is an adjusting event. Because in 31st December 2004, you have recognized a legal provision. Okay? There was an evidence of that. So now you have to adjust it. How? You have to adjust your provision to 7,500. Example 2. In Jan 2005, company purchased 100% of shares of another company. This is a material non-adjusting event because no one knows whether you will acquire it or not. There is no such evidence at the reporting date. So it's a non-adjusting event which you have to disclose as a note in the financial statements. You do not adjust, but you write it, you disclose it as a note. So that's it for IAS 10. These are the 4 questions you can do from your exam kit questions. Meheran, Colette, Rubel, and Wink. Thank you for watching, and I shall see you in the next standard. The next standard is a very important standard and it's a technical standard, which is IAS 12, your income tax. Thank you. Assalamu alaikum. Welcome to video 8. This is IAS 12 income taxes, relevant for both SBR and FR students. So here, the scope of the standard. IAS 12 covers both current and deferred tax, but deferred tax is the most which will be asked and reviewed here. Now, what is deferred tax? Deferred tax is recognized on a temporary difference. Why temporary? Because these differences will go. Okay, it will be removed later on. It is only for temporary period this differences is there. So that's why this deferred tax is recognized on temporary differences between your carrying amount of an asset or a liability and its tax base. Why does deferred tax arise? Number 1, because your accounting profit that you have calculated and the taxable profit, there's a difference. Sometimes the amount that you're deducting to get the profit, for example, depreciation, is not allowable for the tax purpose. That's where that difference occurs, and that difference is only temporary. During the long time, there will be no difference. It will be both same. So that's why There's a difference between the carrying amount of your asset and liability and its tax base. What is tax base? Amount attributed to an asset or liability for tax purpose. Temporary differences can either be two. There are two types of temporary differences. When your carrying amount is more than the tax base, it is known as taxable temporary difference. Why taxable? You can tax on it. It will be taxable further. Okay, which will give rise to deferred tax liability. Okay. Next is deductible temporary difference. When your tax base is more than the carrying amount, it will give rise to deferred tax asset. Now, in your exam, the main thing is to identify whether it's a deferred tax liability or asset. Okay. Now, deferred tax should be measured by applying the applicable tax rate to the temporary difference. First, you get the temporary difference, which is carrying amount minus tax base. Then on that temporary difference, you multiply the tax rate which will be given to you in the question. That is your deferred tax. Okay. So now, what are the sources of taxable temporary difference? That means if these things are there, the temporary differences that you have will be taxable. That means carrying amount is more than the tax base. Number one, depreciation of an asset is accelerated for tax purpose. Okay. That means depreciation of an asset is accelerated for tax purpose means they are giving you more tax allowable expenses to deduct from. That will reduce your tax base. So lower your tax base, there will be a greater difference between the carrying amount and the tax base. So lower the tax base, carrying amount is more. That means temporary difference is taxable. Next, development cost that were capitalized and amortized in your accounts, in your accounting records, but they are deducted as incurred for tax purpose. What happens? Again, it's a taxable temporary difference. In all this case, your carrying amount will be more than the tax base. These are examples, and make sure that you know these examples, because in your exam you might be asked one of this. Could be one of this if it's taxable, and if it's deductible, then could be which we are going to cover in the next slide. Could be one of them. Okay, because you will not be asked outside of this. If there is any scenario, you will only be asked within this. Next, a revaluation. When is the revaluation is done? Revaluation will not increase your tax base. It will only increase your carrying amount. So because tax base does not change, carrying amount changes. So carrying amount becomes more, tax base remains same, does not change. It's a deferred tax liability. Okay. Next, interest revenue received in arrear, which is accounted for on accrual basis, but taxable on cash basis. So again, there will be a difference between the carrying amount and the tax base, because one is on accrual basis, one is on cash basis. Then temporary differences that arise on business combination. If assets or liabilities are increased to fair value, but tax base remains at cost. So that means, so deferred tax will be recognized on that differences, which will be included as a part of net assets acquired. Now, next is the sources of deductible. Here, your carrying amount is less than the tax base. For example, losses in the statement of profit and loss, where tax relief is only available against future profit. Next, intra-group profit in inventory that are unrealized for consolidation purpose, but taxable in the individual company that made the unrealized profit. Accumulated depreciation in the statement of financial position is greater than the cumulative depreciation for tax purpose. Pension liabilities recognized in the financial statements but only allowable for tax when contributions are made to the scheme in the future. Research expense are recognized as expense in accounting profit but not deductible for tax until a later period. And income deferred in the statement of financial position but has already been included in taxable profit. So these are sources of deductible temporary differences. If you are not able to make this out, if you are not able to understand this, I'm sure many of you will not able to understand why is deductible, why is taxable. You have to watch my detailed IS 12 lecture, which is there under my FR playlist and also my SBR. You have to go and watch it. The technical area, that is the calculation part, to understand this better. Now, the accounting treatment. Once you have decided that it's a deferred asset or a deferred tax liability, So deferred tax asset will be recognized on all deductible temporary difference. But to the extent that it is probable that taxable profit will be available in the future. Because if taxable profit is available in the future, you can utilize those losses against the taxable profit. Next, IAS 12F does not permit the discounting of deferred tax liability because it's very complex. So the charge for deferred tax will be recognized in your statement of profit and loss unless it relates to a gain and loss that has been recognized in other comprehensive income. For example, regulations. So in which case your deferred tax also will be recognized in other comprehensive income. Mostly this is for as in property, plant and equipment under IAS 16. If it has been revalued, the gain or loss will also be recognized. The deferred tax gain or loss will also be recognized in OCI. So that deferred tax will be recognized in OCI because gain and loss also was recognized in OCI. Otherwise, almost all of the time, it will be recorded in profit and loss, the deferred tax. Okay. Now, example 1. There are two examples which we are going to go through. Example 1. During a year, company is performing a revaluation on its property. So revaluation surplus is 100,000. Current tax rate is 20%. So therefore, 20% on that 100,000. It's a deferred tax liability. 20,000 will be recognized. Okay. Why liability? Because when revaluation happens, carrying amount increases. Tax base will not change. Okay. Go to the sources of taxable temporary difference. This is the sources of taxable temporary difference. So deferred tax liability will arise. So 20% on 100 is 20,000. So this will be recognized in OCI. Why OCI? Because evaluation surplus goes in OCI. So debit tax expense in OCI, of course, and credit the deferred tax liability. Okay, example 2. Company is making a loss. Mostly loss is deferred tax asset only. Okay, but this loss can be offset against the future profit. Current tax rate is 20%. So deferred tax asset in this case, take 20% of 50, which is 10,000. So deferred tax asset of 10,000 can be recognized provided if it is probable that company is going to make taxable profit in future to utilize that deferred tax asset. Now, these are the 5 exam kit questions. This is for SBR students, not FR students. You have to do Hudson, Hose, MC, Chuckle, and Bohai. Thank you for watching, and I shall see you in the next standard. The next standard is also very frequently tested standard both for FR and SBR students, that is IAS 16 property, plant and equipment. So I shall see you in the next video. Make sure that you do questions on IAS 12 both for FR students and SBR students. Thank you. Assalamu alaikum. Welcome to video 9. This is IAS 16 property, plant and equipment. So first let us go through the cost and the depreciation of an asset. IAS 16 states property, plant, equipment, initially they are measured at cost. And the cost includes their purchase price, less any trade discount or rebate, plus any further cost directly attributable to bring the asset in its working condition or location. Subsequent expenditure on non-current assets, they are capitalized if it enhances the economic benefit of the asset, for example, adding a new wing to a building, replaces part of an asset that has been separately depreciated and has been fully depreciated. For example, furnace that requires new lining periodically, or replace economic benefit previously consumed, major inspection of aircraft. All this expenditure you can capitalize. Now, the aim of this depreciation is to spread the cost of the asset over its life in the business. So IAS 16 requires depreciation method, useful life has to be reviewed at the end of each year and has to be revised if it's necessary. This is not a change in accounting policy. Change in accounting method and useful life of the asset are changes in accounting estimate which will be dealt according to IAS 8 prospectively. And if an asset has a part with different lives, for example, a building with a flat roof, then the component part has to be capitalized and separately depreciated. Now, example 1. A hotel company is undertaking building work to extend its hotel from 20 rooms to 25 rooms. So this is increasing their earning capacity of the hotel. Okay, which means it is representing an enhancement of the economic benefit. Therefore, This cost of extension you have to capitalize. Very important in IS 16, what to capitalize and what not to capitalize. Okay. Now, example 2. Hotel company is undertaking a refurbishment of its hotel involving repainting of all the guest room. Remember, repainting will not enhance the economic benefit. So the cost of repainting should not be capitalized. They should be taken as expense in P&L. Now, revaluation. Revaluation of your PPE is optional. But if one asset is revalued, all assets in that class has to be revalued. Valuation has to be kept up to date so that your carrying amount does not differ materially from the fair value at each statement of financial position date. Now, very important for revaluation, revaluation gain and revaluation loss, how do you deal with it? If it's a revaluation gain, they are credited to other comprehensive income. Unless the gain reverses a previous revaluation loss that was recognized in statement of profit and loss. Okay. Next, if it's a revaluation loss, you will debit in your profit and loss. Unless the loss relates to revaluation surplus, previous revaluation surplus, which you will debit from the OCI first and the extra will go to profit and loss. Okay. Now, depreciation on revalued assets. So depreciation which is charged on your revalued asset, that is revalued amount minus the residual value over the remaining useful life of the asset. That's how you get the depreciation on a revalued asset. And because your asset has been revalued, now depreciation will be more. Okay, so that excess depreciation you can transfer from revaluation surplus to retained earnings. There's a choice that entity can do that. If it is done, it has to be done consistently each year. Now, example 3. A hotel chain is undertaking a revaluation of its property for the first time, resulting in a revaluation gain of 250,000. So this 250,000 will go in OCI. In 2005, they have got a revaluation loss of 50,000. So what should you do? See, earlier there was a gain. Now it's a loss. So first, the loss has to be taken to other comprehensive income because there was a gain that has been recorded in OCI previously. Then the balance will be reduced, will go to profit and loss. So first 50,000 loss that have occurred. Okay. So you have to separate the 50,000 and 200,000. Okay. Now, loss of 50,000 will be taken to other comprehensive. The balance 200 will be taken from, will be reduced. So the balance on your revaluation surplus, see, from 250 you will reduce only 50. So that 50,000 you will only take from OCI. Still you will be having 200,000. Okay, then your revaluation surplus will fall down to 200,000 from 250 because loss is only 50,000. Now, but had a gain not previously been recognized, then the entire loss will go in the statement of profit and loss. Now, thank you for watching and I shall see you in the next standard, which is IAS 19. By the way, IAS 19 employee benefit is not there for the FR students, but it is there for SBR students. But if FR students want as an option, they can do watch the video or they can simply skip and go to the next standard, which is IAS 20 government grant. Thank you. Assalamualaikum. Welcome to video 10. This is IAS 19 employee benefit. This standard is not there in your financial reporting, but it is there for the SBR students. Okay, and it is a standard which is definitely going to come in your SBR exam since it has not been asked in FR. So, IAS 19 deals with accounting for pensions and other employee benefit. There are two types of pension scheme. One is known as defined contribution pension scheme and the other one is defined benefit pension scheme. First, let us go through the contribution scheme. A defined contribution scheme is where employee is going to pay a fixed amount to a separate entity regarding pension. Employer has no obligation to make any further payment if the fund does not have sufficient assets to pay all their employee benefits. Example 1. Where entity is paying a fixed contribution of 5% of the employee's salary into the pension plan each month. So entity has no obligation to make any further payment beyond this 5%. So the monthly salary will be totally 100,000. Okay. So the entity will reckon, if you, let's say the monthly salary is 100,000. If you take 5% of 100,000, which is 5,000. So entity will recognize an expense of 5,000 in their statement of profit and loss. Why expense? Because employer has to pay this to employee. So from the employer's side, it's their expense. For employee, for them, it's an income because they are going to get a salary. But we are talking from the employer's point of view. Okay, they will recognize this as an expense in their statement of profit and loss. Next is defined benefit. The most complex accounting issue is the defined benefit. Okay, and mostly questions on SBR are on this scheme. This is where an employer has an obligation to provide an employee with a specific level of pension on retirement, usually based on a percentage of final salary. So to estimate the fund required, an actuary will have to calculate the contribution that is required so that ensure that the scheme will have enough fund to pay out its liabilities. This involves estimating what may happen in the future, such as the age profile of employees, retirement age, etc. A pension scheme consists of pool of assets, could be cash, investments or shares, and liability for pensions owed to employees when they are at the retirement age. So the assets are used to pay out the pension. Okay. Now, you don't need to know how the scheme works. You need to know how to measure and recognize. That's what is going to be asked in your financial statement. First, let us go to the statement of profit and loss. So, in your statement of profit and loss, you will recognize the service cost, the current cost, and the past service cost. Both current and past service cost. This will be given to in the question. You only have to know which place it will be recorded. So, current and past service cost will be recognized in your statement of profit and loss. Also, any gain and loss that arises on curtailment and settlement. What is this curtailment and settlement? We'll see this shortly in some time. Okay, definition of these terms are given. Curtailment, settlement. So any gain from this two will also be recognized in your statement of profit and loss. The next item that goes in your profit and loss is net interest component. Like any liability, interest will be charged. Here also it's like that. Next, statement of financial position. So in your profit and loss, three things goes: current and past service cost, gain and loss on curtailment and settlement, and net interest component. In your statement of financial position, either it's an asset or a liability. Okay, so net scheme asset or liability will be recognized, and assets are measured at fair value, and if it's liability, it will be measured at present value. This you have to remember: assets at fair value, liabilities at present value. And other comprehensive income, remeasurement of your net defined benefit liability or asset. Anything could be remeasured. It could be asset also, it could be net benefit liability also, such as actuarial gain or loss, and return on your plan assets will be recognized in other comprehensive income, and it will never be recognized in P&L, reclassified to P&L later on. Okay, so these three are very important from the point of your SBR exam. Now, definitions. So you have to know some definitions under IS 19, very important. What is current service cost? Current service cost will increase, okay, is the increase in the actual liability. For example, present value of the defined benefit obligation. This will result from your employee service in the current period. And this is a part of the service cost component. Service cost component is divided into two, current and past. One is current, that means currently what is your expense to service your employees. Okay, next is past service cost. This also is an increase in your actual liability related to employee service in the previous period but only arising in the current period. Okay, so past service cost will usually arise because there has been improvement in the benefit to be provided under the plan. So these are the part of the service cost component and will be recognized when the plan amendments occur. That means when you change the plan, past service cost will come. For example, now plan has benefited. There has been improvement in the benefit. And settlement. Settlement occurs when an entity enters into a transaction to eliminate the obligation for part or all of the benefits under a plan. What does it mean? See, whatever the obligation you have will automatically go off if you settle it off. You only have an obligation until the settlement is done. Once the settlement is done, no obligation. But if the settlement is done fully, no obligation. If settlement is done in partly there will be some obligation. Okay. So when you do the settlement, Any gain or loss on that settlement is the part of the service cost component. Remember this. Now, next, curtailment. I told you curtailment, amendment. What is curtailment? Curtailment, very important. You might be asked questions on curtailment, okay? This occurs when an entity is making a material reduction in their number of employees that will be covered by that plan, pension plan. That means they are, let's say, laying off their employees, or they are amending the terms of the plan such that the material element of the future service by the current employees will qualify for or no reduced benefit. That means it, you can say this one synonym for curtailment, you can say reduction of employees that are going to get benefit of this plan. Either you are reducing it or you are amending the terms of the plan in such a way that now benefit will not go to so many employees. So this may occur if an entity closes a plant and make employees redundant. So you can make it curtailment with redundant, making employees redundant. And any gain or loss on curtailment is part of the service cost component. Okay. Next, net interest. Net interest is applying discount rate to the net liability or asset at the start of the reporting period, not at the end, start. Okay. All this amount you will be given: net interest, past service cost, present service cost, current service cost, everything. The remeasurement component, this is a balancing figure you have to find out. So the remeasurement can result either from increase or decrease in your pension asset or liability. Like any asset or liability, when there is a remeasurement done to fair value, we have some gain or loss, right? Because that change can happen because of actuarial estimates. See, actuarial is a person who puts a valuation to an amount. It's like an estimation, and they are highly skilled in that. There is a service called actuary service, and it's highly valued, by the way. It's risky but very highly valued if you want to, go later on. But anyway, let's come back to the topic. So if the estimate changes, it will change. So this component is recognized in your other comprehensive income, and it will never go to your profit and loss. Now, example 2. The following information relates to a defined benefit pension plan. Let us go. First, present value. See, this is a question, okay? Present value is given. Fair value at the start is given. Then discount rate 4%. Current and past service together is given 30,000. Benefits paid 20,000. Contributions 25. Present value and fair value. So they have given you the present and fair value at the start and at the end. Okay. Now, what are you supposed to do? You have to find out the remeasurement component, the balancing figure from this. Okay. So the financial statements will show the following for the year ended 31st December 2004. Let us go. So this is your solution. This is how it will look like. Remember, in your exam, you will not be told to draw up the entire statement of financial position or profit and loss, only the extracts. So statement of financial position. First, let us find out. You have to first find out asset or liability. How do you do that? See, to get the net liability, just take the closing balance and deduct the opening balance. You see, your opening present value of obligation is 140,000 and closing is 200,000. So 200 minus 120, the balance is your closing net liability, 80,000. Earlier, your present value was 140 and close value increased to 200. So it increased by 80,000. So that closing net liability will go in your statement of financial position. Next, statement of profit and loss. Service cost component 30,000. Net interest component will also go. How are you going to get the net interest component? On your asset. So fair value of planned assets. Fair value of planned asset was 80 in the beginning and 120. Net interest component you have to find in the opening balance. Closing balance will not. So that is simply, okay, your present value of obligation 140, fair value of planned asset 80. So the difference 140 minus 80, and you have to apply 4% interest. That is 2,400 will go. Next, other comprehensive income, the remeasurement component, which is calculated below. It's a working. We'll see how 12,600 we got. So first, net obligation brought forward. Net obligation. Net obligation means the difference. Okay. Then service cost component 30. You have to add. Net interest, add. Contributions into plan, deduct. You have to know what to add. With the net obligation, you have to add service cost and net interest cost. Why it's net obligation? Because your present value of obligation is more than your planned assets. So you see, you can net off your asset and liability. One thing in as IS 19 is you can net off your asset and liability. So the opening balance of your asset and liability. Liability is more. Liability is 140, asset is 80. So 140 minus 80 is 60,000. The difference. Okay. So 60,000 brought forward balance. Net obligation, because obligation is more. Present value is more than fair value. Liability is more than asset. That's why it's net obligation. Otherwise, it would have been net asset. You understand? Service cost you will add. Net interest you will add. Contribution you will deduct. Okay. And remeasurement component is a balancing figure because you have been given the carried forward balance. So how? Simply take your present value at 31st December and fair value at 31st December. Just take the difference. Here also present value is more. 200 minus 120. Difference is 80,000. Okay. So it's a net obligation. So remeasurement component is simply the balancing figure, which will go in your other comprehensive income. Knowing this much is enough for IS 19. These are the 5 questions you have to do from your exam kit questions. ICOMA, DigiWire, Hudson, Columbia and Symbol. Thank you for watching and I shall see you in the next standard, which is IS 20, which is government grant and government assistance, applicable for both FR and SBR students. Now it's your job to do questions on IS 19. Okay, because definitely you will be tested on IS 19. It's a question which has a chance of coming 100%. Okay, 100%. Thank you. Assalamualaikum. Welcome to video 11. This is IS 20 government grants and government assistance, applicable for both SBR and FR students. So IS 20 government grant. First let us go through government grant and then we'll discuss government assistance, because the way we account for these two are different. Okay, a government grant are any type of assistance by government in the form of transfer of resources to an entity in return for complying, where either in the past you have complied with certain conditions or in the future if you comply with certain conditions, you will be eligible for the grant form of government. So a government assistance is action by government designed to provide economic benefit to a specific entity. That is a assistance. Now, accounting treatment. IS 20 says grants are not to be recognized until there is a reasonable assurance that A. Conditions that are attached to the grant will be complied with. B. Grant will be received. So if these two conditions are met, you will recognize the grant. Now, grant shall be recognized in the statement of profit and loss as to match them with the expenditure towards which they are intended to contribute. Now, there are two types of grant. One is known as capital grant, that is towards the cost of the asset, and the other one is towards the other grant is income grant, towards the expenses. So first let us go through an income grant. Income grant given to subsidize expenditure has to be matched with the related cost. Income grant is given to achieve a non-financial goal such as job creation. So this should be matched to the cost that are incurred to meet that goal. Grant for purchases of non-current asset has to be recognized over the expected useful life of that related asset. Same like depreciation expense, how you recognize. Okay. Now, so there are two acceptable accounting treatment for grants that are relating to non-current assets. I told you there are two types of grant. One relating to non-current assets, other one related towards expenses. First, let us finish towards grant relating to non-current assets. There are two accounting treatments. First, either deduct the grant from your cost of asset and depreciate the net cost. Or second treatment, treat the grant as a deferred income and release it to the statement of profit or loss over the life of the asset. How you release depreciation or amortization, same way. Okay. Next, Grants that become repayable. What if your grants become repayable? Now you have to pay back the grant back to the government. There are conditions. If you meet, you have to pay back. A government grant that becomes repayable, you have to account it as a change in accounting estimate. Okay. Example 1. An entity is receiving a government grant of 1.5 billion to subsidize the cost of employing people in areas of low employment over the next 3 years. Now, the grant should be matched to the cost in each year. Therefore, grant initially you have to recognize it as a deferred income, and each year 1.5 divided by 3, each year 500,000 has to be credited to your statement of profit and loss. It's an income, and it will be offset against the related payroll cost. So this grant that you are crediting to statement of profit and loss will be offset against the cost, related payroll cost. That is the effect of the grant. Okay. Example 2. An entity is receiving a government grant of 0.5 million towards the purchase price of a building. First one was regarding a cost. Now this is about a non-current asset. So there are two ways. First, and the purchase price is 3 million. Useful life is 50 years, and you are going to depreciate it on a straight line basis. So grant can be accounted for in two possible ways. See, this two possible ways is only when it's a grant towards the non-current asset. Okay, remember. For cost, it's only one way. You recognize it as a deferred income over the life of the grant. Now, reduce the cost of the building by 0.5 million, that is the amount of the grant, or the building will be included within property, plant and equipment at 2.5 million, that is 3 minus 0.5, and you will depreciate. Okay, so when you reduce the cost of the building, this is, we are still in the first one, I'm sorry. When we reduce it the cost, so cost becomes 2.5. This 2.5 you will divide by 50 to get the depreciation, which is 50,000, which you will charge each year for 50 years. Or the second method, you will recognize the grant of 0.5 million as a deferred income, and you will amortize it over the statement of profit and loss over the useful life of the building. So what is the cost of the building? 3 million. That 3 million you will divide by 50, depreciation will be 60,000. Okay. Next, you are recognizing a grant as an income. So 0.5 million also you will depreciate over 50, amortize over 50 years, which is income of 10,000, which you will credit to your statement of profit and loss. And the deferred income liability will be shown in your statement of financial position. Okay, which will reduce by 10,000 each year. It will keep on reducing by 10,000. Okay. So thank you for watching, and make sure that you do questions on IS 20 on both the presentation and see whether you have understood the concept of IS 20 or not. The next standard will be on IS 21, that is foreign exchange. Once again, it's applicable for both SBR and IFRS students. Thank you for watching. Assalamu alaikum. Welcome to video 12, IS 20, the foreign exchange. Applicable for both SBR and IFRS students. So in IS 21, it is giving you guidance on accounting for foreign currency transactions. There are two types of currency that you should be aware of, functional and presentation, and this can often be asked as a discussion question. Okay, for example, what is the functional currency of the foreign country? Now, a company has to determine both this functional and presentation currency. Functional currency is the currency of the primary economic environment in which entity operates. IS 21 says that presentation currency is the currency in which entity is presenting their financial statement. Now, in determining functional currency, IS 21 specifies entity should consider the following: the currency that influences its sales price for goods and service, currency that influences the cost. If a company is a foreign owned subsidiary, it will have the same functional currency as its parent. If it operates with little autonomy, that means not much freedom is given to that foreign owned subsidiary. So they will follow the same functional currency as the parent. Once determined, functional currency should not be changed. Okay. Now, presentation currency can be any currency, and it can be different from functional currency. This is particularly if the company is a foreign controlled, and foreign control as the presentation currency may be that of the parent. If the presentation currency is different from the functional, your financial statement has to be translated into the presentation currency. Now, individual transactions in foreign currency. If a company enters into a foreign currency transaction, okay, the result has to be translated and recorded in the accounting records at the rate on the date of transaction that has occurred, or using an average rate over a period of time, providing the exchange has not fluctuated very significantly. Now, a subsequent statement of financial position date, at subsequent, this following process has to be applied. If, see, you have to identify what you are exchanging. Based on that rate, you have to decide the rate. If it is receivable, payable, cash, loan, you will translate them using the closing rate. Okay. The closing rate is the exchange rate at the statement of the financial position date. This will be given to you in the Excel. Okay, all these rates and all. You don't have to determine. You don't have to calculate. You just have to know which rate to use. So this for receivable, payable, cash, loan, they are grouped into one category. They are known as monetary items. Okay, receivable, payable, cash, loan. So this monetary items, whenever you translate monetary items, it is always at closing rate. You have to remember. And second category, non-current asset, investment, inventory, they are not retranslated and they are non-monetary items. Okay, you will only translate them once and at the historic rate. Okay, or the date at the transaction rate at the transaction date. So any exchange differences that relates to the monetary items will be recognized in your statement of profit and loss. Why monetary items? Because non-monetary items you are not retranslating again, no. But monetary items, first time you will translate at the transaction date. Second time you will translate at the closing rate. So there will be difference. That difference is known as exchange gain or loss. That difference will go in your profit and loss. Okay. Now, if a company as a foreign subsidiary whose functional currency is their local currency, then the financial statement has to be translated into the parent's presentation currency. Remember, foreign subsidiary cannot keep their account in their currency. It has to be translated into the parent's presentation currency, because at the end you have to consolidate and currency has to be same when you're consolidating. Before you consolidate, you have to keep in the same currency. So all asset and liabilities will be translated into the parent's presentation currency at the closing date. Goodwill will be calculated. See, when it comes to goodwill is a tricky area. Asset and liabilities are easy, closing date. But goodwill, you have to calculate in the functional currency of the subsidiary first. Keep it in the functional currency of the subsidiary and calculate the goodwill. Then translate at each reporting date at the closing date, because goodwill is also an asset which comes in a statement of financial position. So it makes sense that you are going to translate it using the closing date. Okay, so then at the closing date into the presentation currency of the parent. When you calculate goodwill, be careful. Okay, then any income and expense in the statement of profit and loss will be translated at the average rate. Okay, income and expense, any items that goes in your statement of profit and loss, use average rate. Any statement that goes in the statement of financial position, closing rate. Okay, now exchange difference that arises on consolidation will be recognized in other comprehensive income until you dispose the subsidiary. Once you dispose the subsidiary, then any gain and loss in OCI will be transferred into profit and loss. Okay. Exchange difference can arise from, this is very important. Okay. One, there are two areas how exchange difference can arise. First, when you are retranslating your opening net asset using the closing rate. See, opening net asset, first you have translated at opening rate. Now you are retranslating at closing rate, two different rates. That's why exchange difference can arise. Second, when you are retranslating the profit, okay, from the average rate to the closing rate. See, profit, when you first time translate, you use average rate. But second time when you're translating it, that means retranslating it, it is at the closing rate. First time when you're translating using average rate, it goes in the statement of profit and loss. Second time when you're retranslating it, to include it in the statement of financial position. Now, these are the three exam kit questions you have to do: Hummings, Kerbis, and agency group. Make sure that you do it. And IS-21 is also a very frequently tested area, because they also want to check your overseas aspect. Thank you for watching, and I shall see you in the next standard, that is IAS 23, that is borrowing cost. Thank you. Assalamu alaikum. Welcome to video 13, IAS 23 borrowing cost, applicable for both SBR and FR students. This is a very short standard. Basically, this standard is about whether you can capitalize the borrowing cost as an asset or not. There are some criteria that you have to meet before you can capitalize your borrowing cost as a part of asset. Okay, so IS 23 requires your interest expense to be capitalized. Interest means interest on your borrowings to be capitalized if they are directly attributed to the construction or acquisition of a qualifying asset. What is a qualifying asset? A qualifying asset is a one which takes a long period of time to get ready before it can be used or before you can sell it. But if an asset does not take a long amount of time, remember it's not a qualifying asset. Okay, very important, you have to take the borrowing for a qualifying asset. If it's not a qualifying asset, you can't capitalize the interest expense as a part of cost, as a part of capital. So the capitalization, when does it starts? From the day when construction begins, and when your asset is ready for use, that time your capitalization will cease. So borrowing cost that has been incurred after the asset is completed or while the work is suspended will be taken as an expense in your profit and loss. They will not be capitalized. And the capitalized borrowing cost are those actually incurred, although this may be estimated if the entity is financing the cost out of general borrowing. Now, let us go through this example. So on 1st August, company is borrowing 400,000 from bank to construct a building with a cost of 500,000. The interest rate on loan is 6%, and they have commenced the construction on 1st October 2004 and it was completed 30th June. So first you have to take the borrowing cost of 400,000, apply 6% rate, but for how many months? From 1st of October to 30th June. So October, November, December, January, February, March, April, May, June, only for 9 months. Okay, so 400 into 6 into 9 months, the borrowing cost is 18,000. This 18,000 you will capitalize it as a part of cost of the asset, and then you will depreciate it like how you depreciate non-current asset. But depreciation will start once the asset is ready for use from that day. Thank you for watching. This is all about IS 23. Now make sure that you do questions from your revision kit on IS 23, because IS 23 is a standard which often comes with your IS 16, that is your property, plant and equipment. So it's very important in your exam to see whether you have acquired an asset, a ready-made asset, or you are taking a loan or borrowing to construct an asset. Okay, if it's a ready-made asset, IS 16 will apply, non-current asset. But if it's a asset that will take time before you can use it or sell it, for which you have taken a loan to construct, then you have to apply IS 23. The next standard will be IS 24, which is related party, and on which ethical question is asked for SBR students. IS 24 is not relevant for financial reporting, but it's there for SBR. So thank you. Assalamu alaikum. Welcome to video 14. This is IS 24 related party disclosure, relevant for SBR students and not FR students. And it's very important for SBR students because often this question comes in your ethical question in your SBR exam. Okay, ethics mostly comes from related party, this topic. So normally this is you have to write about it. You have to disclose if there are any related party disclosure. You have to identify who are related parties. They will normally not ask you a calculation, a numerical question on the standard. Okay, so who is a related party? A related party is an entity or a person that is related to the entity who is preparing their financial statement. IS 24 is giving the rules which should be used to determine the existence of related party relationship. A related party transaction is the transfer of any resource, service, or obligations between the related parties, regardless of whether a price is charged or not. So, this other related party, a person or a close member of that person's family, is related to a reporting entity. First we'll see the person who's related to a reporting entity, then we'll see an entity that is related to a reporting entity. So A. And in your exam, you could be asked any of the scenario. So you have to know this total list of who is related and who is not. Because if you are not able to identify who is related or not, you will not be able to apply IS 24. So a person or a close member of that person's family is related to a reporting entity if that person has control or joint control of the reporting entity. Control means you are having more than 50%. Okay, joint control means when 2 or 3 people are having a unanimous consent before making a decision. That is for joint venture and joint control. Next, having significant influence over the reporting entity. So the person is having significant influence means they are an associate, more than 20 and less than 50%. Is a member of the key management personnel of the reporting entity or of the parent of the reporting entity. So they are the key management personnel. For example, they are the CEO or the CFO or the financial manager, the finance director, people like in the top level. They are not low level or middle level managers. Someone who can influence the decision making. Someone who's sitting there on the board. Could be a member in the reporting entity or the parent of the reporting entity. Then they are related to reporting entity. Next category, the B. This is when an entity is related to a reporting entity. If any of the following conditions apply. First, entity and the reporting entity, they both are the members of the same group, which means parent, subsidiary, and their subsidiary are related to each other. One entity is an associate or joint venture of another entity, or an associate and joint venture of a member of a group of which the entity is a member. Both entities are joint ventures of the same third party. One entity is a joint venture of a third entity and the other entity is an associate of the third entity. So that joint venture and that associate are related because they are both member of that third entity. Now, entity is a post-employment defined benefit for the benefit of employees of either the reporting entity or an entity related to reporting entity. If the reporting entity is itself such a plan, then the sponsoring employees will also be related to the reporting entity. Sixth, the entity is controlled or jointly controlled by a person who are identified in A. That means could be controlled by associate, subsidiary, joint venture. Person identified in AI as a significant influence over the entity or is a member of the key management personnel of the entity. Entity or any member of a group of which it is a part provides key management personnel service to the reporting entity or to the parent of the reporting entity. Now, the disclosure. So that's about identifying who are the related to reporting entity, both the person and the entity. So you are supposed to disclose relationship between parents and subsidiaries, irrespective of whether any transactions have taken place between them or not. The name of the parent and the ultimate controlling party if they are different. Key management personnel in total and for each short-term employee benefits, post-employee benefits, other long-term benefits, termination benefits, and share-based payment of each of these key management personnel needs to be disclosed separately. Okay, for example, what is their employment benefits, what is their post-employment benefit, for separately for each key employee you have to disclose. You don't have to aggregate them, you have to show it separately. Next, for related party transactions that have occurred, what is the nature of the relationship and the detail of the transactions and the outstanding balances. Disclosure that should be made for each category of related parties stated above and includes amount of the transaction, amount of outstanding balance and their terms, allowance for doubtful debts relating to the outstanding balance, the expense recognized in the period in respect of irrecoverable or doubtful debt due from related parties. Now, let us go through an example. Let's say a vehicle is having a carrying amount of 10,000 where the market value is 12,000 and at the board meeting, the finance director has authorized that the purchase of the vehicle will be for 8,000. So at the end, invoice relating to this transaction was unpaid. This is a related party transaction. Why? Because the finance director is a key management personnel. So it's very important for you to identify who are key management personnel and who are not. Okay. So this related party disclosure notes should disclose the transaction amount of 8,000 and also the balance outstanding of 8,000. If the debt is considered to be doubtful, you have to make the allowance regarding the 8,000 invoice. This also you have to disclose. Now, remember, if you're not disclosing a related party transactions or its amount, is unethical. Okay, that is the common scenario which is often tested in SBR exam. In your question number 2, from your exam kit questions, you have to do questions 10, which has related party disclosure question. Thank you for watching, and I shall see you in the next standard, which is IS 27, which is again applicable for both SBR and FR students. IS 27 is separate financial statement. Assalamualaikum. Welcome to video 15 of financial reporting. This is IS 27 separate financial statement. This is relevant for both FR and SBR students, but normally this is not asked. But if it is asked, you should be able to know how to account for it. This is a very short standard and it is often asked in a group accounting. So this standard applies when an entity has interest in subsidiaries, joint ventures or associates, and they elect or they're required to prepare separate non-consolidated financial statement. So if a separate financial statements are produced, investments in subsidiaries, associates or joint ventures can be measured at cost at using equity method or in accordance with IFRS 9. Mostly for associates and joint ventures, we use equity method, that is IAS 28. Then other investments we normally measure according to IFRS 9. And subsidiaries we measure at cost. That's it for IAS 27. There are not much questions that you will get on your revision kit on IAS 27, but I think maybe 1 or 2 questions are there where they often ask, apart from consolidated, they ask you to prepare separate financial statement. So make sure that you do those questions because you should know how to prepare separate financial statement along with consolidated. The next standard will be on IAS 28, which is investment in associates and joint ventures, again a group accounting standard, which is applicable for both SBR and FR students. Thank you for watching and I shall see you in the next video. Assalamualaikum. Welcome to video 16 of financial reporting. This is IS 28 investments in associates and joint venture. This standard is applicable for your consolidation purpose. And this standard is going to definitely come because you will be tested on your consolidation. So IS 28 will be tested in both your SBR and FR, which makes this standard a very important standard. So under IS 28, let us first understand what is joint venture. You have to understand 2 things. One, joint venture and one, associates. Because IS 28 is going to deal with both of them, joint ventures and associates, but the way you measure them are same. Okay. Joint venture is where you are having a joint arrangement where the parties are having joint control on the arrangement. Okay, so they have the right to the net asset of the arrangement. This will normally be established in a form of a separate entity to conduct the joint venture activities. What is associate? Associate is an entity over which investor has a significant influence, not control. That means if you are taking it in terms of the percentage, it is 20 to 50%. If you are having any interest between 20 to 50%, you are an associate. More than 50%, more than 20% and less than 50%. Significant influence is the power to participate in decision making, both in the financial and operating, but it is not a control, nor is a joint control. Normally, significant influence means you are having a shareholding of 20 to 50%. So in the exam, either you will be given the percentage to decide whether you are having a significant influence, to decide whether it's an associate, or you will be given whether they have the power to participate in the decision making of the investee. Now, equity accounting. So the one thing under IS 28 is whether it's a joint venture, whether it's an associate. Once you have decided it's an associate or it's a joint venture, both you have to use equity accounting to measure them in your financial statements. Equity accounting. So in your consolidated financial statement, an investment in an associate or a joint venture is accounted using equity method. In your consolidated statement of profit and loss, they will only show a single figure regarding associate or joint venture. That is the investor's share of the associate or the investor's share of the joint venture's profit for the year. That is the only one figure which they will show. But yes, definitely for that you have to show workings. And on your consolidated statement of financial position, you will show the investment in the associate or investment in joint venture as non-current assets. So how do you calculate the equity accounting? Initially you will measure your associate or joint venture at cost, but the subsequent measurement will be you have to take the investor's share of the post acquisition profit. So your cost will increase or decrease by the investor's share of the post acquisition profit. If your profit increases, your cost you have to add it with the cost, and if it decreases, you will decrease it with the cost. So it can increase or decrease. That is equity accounting. So with the initial cost of investing in associate or joint venture, you add the post acquisition profit if it increases, or deduct if your post acquisition profit reduces. And you have to take the investor's share only. So investor share is you will be given in the exam. For example, they told that you have bought 30% shares. So that 30% is an associate. So you only have to take 30% of the post acquisition profit. Now, remember, associates and joint ventures, we do not consolidate them. Why? They are not part of a group. So therefore, any transactions and balances between the group companies and the associate and group companies and joint venture, they are not eliminated from your consolidated financial statements. Unlike subsidiary. What happens with subsidiary? When you're owning more than 50%, when you're having any transaction with subsidiary, that is eliminated on consolidation. All intergroup transfer and balances are eliminated on consolidated financial statements, but not for associates and joint ventures. Now, let us understand how do we use equity accounting through this example. So, P company is preparing group accounts on 1st Jan. They have purchased 30% shareholding in A for 30,000. So, what is the cost? Cost is 30,000. Retained earnings in the beginning was 25,000, but at the end it's 40,000. So, you have to say how much your retained earning increased, and you have to take 30% of that. So, A's profit for the year was 5,000. How did they get 5,000? So they have given the A's company's profit. Now, this is how in your consolidated statement of financial position it will look like. So investment in the associate will be shown under the non-current assets. That is 30,000 cost plus 30% of 40 minus 25, your post-acquisition reserve. Okay. Now, in your consolidated statement of profit and loss, remember, in your statement of financial position, you don't have to prorate. It doesn't matter what time of the year you are buying the associate. But when it comes to profit and loss, you only have to take for the period that you are an associate. If you're buying in the middle of the year, okay, if you're acquiring the associate, you only have to take for the portion that you are being an associate. So in this case, you see, you have bought it 1st Jan, associate. Now, at the end of the 30th June, that means after 6 months, they have given you what is the retained earnings. So at 30th June, from 1st Jan to 30th June is only 6 months. So you can only take the profit of 6 months, not for the whole year. Okay. So here, profit is 5,000, but that is for the year you are given. You have to take 30% of it because that is the share, investor's shares in that associate. And you have to take for 6 months. So 5,000 into 30% into 6 months, which is 750. So in your consolidated statement of profit and loss, you will show 750 as a share of profit of the associate. If that investment in A, that is your associate, if it is impaired for any reason, which could be impaired. Okay, in your exam, your associate could be impaired or it could not be impaired, anything. If it's impaired, then that impairment charge will be deducted from the share of profit of the associate because it's an expense and you are having a profit. So that expense will be deducted from that profit and you will be shown the result. Thank you for watching, and this is all about IS 28. But IS 28, you can't do a question because you will not get one question where IS 28 is tested as a standalone standard. It is often mixed and combined with other group accounting standards like IFRS 3, IFRS 10. For example, a parent might buy one subsidiary, one associate, or two subsidiary, or two associates. So you have to deal IS 28 along with other standards that are group accounting. But when you're doing your group accounting questions, you will find out that there are other standards also that is applicable for the same question. But you can skip that and you can only do where you have to calculate joint venture or associate. That is using only IS 28 wherever it's relevant. So that you can do from your revision kit questions. And in your FR, you will not be asked to account for joint ventures. It is only for SBR students, which is both associate and joint venture will be asked. But for FR students, it is only associate. So thank you for watching, and I shall see you in the next standard, which is again a very important standard. It is IS 32, which is your financial instrument classification. Assalamu alaikum. Welcome to video 17 of financial reporting. This is IS 32 financial instrument presentation. Now, financial instruments are divided into three separate standards. One is IS 32, one is IFRS 7, and one is IFRS 9. So in this, we are going to only go through the presentation part. The main measurement, recognition, discontinuation will be covered in under IFRS 9, and IFRS 7 is only on financial statements disclosure. So these three standards, they work together. Now, in this standard, the main question is whether to present the financial instruments as your financial liability or equity. Okay. IS 32 says that a financial instrument has to be classified as a liability if the issuer has a contractual obligation to deliver cash, that means to pay cash or another financial asset to the holder, or to exchange another financial asset or liability with the holder under conditions that are unfavorable. Financial instrument is classified as equity if no such contractual obligation arises. So in your exam, you should always see whether there is an obligation for you to pay the cash or not. If no obligation, it's equity. If obligation is there, it's debt. That means financial liability. Now, for example, preference shares could be classified both as equity and liability. If it's irredeemable, it's equity, and if it's redeemable, it will be classified as a debt. Now, one very common example they will often ask is compound instruments to test your knowledge of IS 32. This is the only area they test on IS 32, that is compound instruments, where an instrument has the element of both liability and equity in one instrument. One example is a convertible bond, a bond which you can convert to shares or cash. So bond is a liability, but because you can convert it into cash or shares, it has an equity component also, and we don't know whether we are going to convert it into cash or fixed number of shares, right? So you have to split the compound instruments into two parts, liability part and equity part. And often you have to first start your calculation by finding the liability part first. Equity is the balance. How? Present value of the repayment. That is the liability component. So the difference between the proceed, they will often give you what is the proceed, minus the liability component that you have found, the balance is equity element. And let's go through an example. So on 1st Jan, company issued 10 million 3% bonds. Interest is paid in arrears. So the loan notes will be redeemed in cash on 31st December 2006. That means after 3 years in the form of fixed number of ordinary share. First, you have to find out an interest. Let's say you are just having a loan and you want to convert it. You have to find the present value, but without the conversion part. So the interest on a similar bond without the conversion is 6%. So this bond you can see has the characteristics of both debt and equity. So you will split it into debt equity. First, let's find out the present value of the cash repayment discounted using the interest rate given for similar bond without the conversion, which is 6% in this case. So this is how it will go. Okay, forget about the present value. Let's see how we got the present value 9.2. So your cash amount is 10 million. Often they will give in the question interest rate, amount, interest rate, everything will be given. You just have to find out, do the calculation. So 10 million into 3% into 1 divided by 1.06, because for the first year, end of 31st December 2004, only for 1 year. Why 1 divided by 1.06? Because 6% is the interest. You are discounting now. So if you discount it at 3%, 10 million of 3%, it is 0.28. Then for 31st December 2005, same calculation, the whole thing is 1 divided by 1.06 to the power 2, because this is for 2 years. And then for the third year, 10 into 3% into 1 divided by 1.06 to the power 3. But remember, this time you have to add another 10. Why is that? Because the principal amount you will pay at the end of 31st December 2005. By the third year, you are going to pay the interest plus the principal amount, which is 10 million. But in the first 2 years, that is 2004 and 5, you are only paying the interest. That's why we are taking only 3% of 10 million. And that's why you see your amount is more. It's 8.65 in the third year. So you will add all, that is your present value. When you add 0.28 plus 0.27 plus 8.65 is 9.2 million, which is the present value of cash repayment. So double entry will be, you should know the double entry. You debit cash because you're receiving cash and you credit the liability 9.2. Now you see the difference? There's a difference. That difference is credited in the equity, 10 minus 9.2, which is 0.8. Now, so at 31st December 2004, remember we have to find the interest on 9.2 million. So that is the present value of future payment, which is 9.2. So you have to find 6% of that 9.2, which is 0.55. So this 0.55 will be charged to your statement of profit and loss. It's an interest expense. Okay, and you have to deduct it from the liability. Sorry, you have to add it with the liability, because with your capital amount this interest also will be charged, which is 9.2 plus 0.55 minus 10 into 3%. Why 10 into 3%? The interest of the next year you have to deduct. Okay, so your liability will be 9.45. Now equity is not remeasured, only the liability is remeasured. Okay, so that's it for IS 32. Make sure that you do questions on IS 32. There are enough questions on compound instruments in your exam paper. You just have to go and do it right down, so that you are able to split the equity and the liability component and very frequently asked questions. So make sure that you do this question right now. And I shall see you in the next standard. The next standard is IAS 33, earnings per share. Another very technical standard with lots of calculations. Assalamualaikum. Welcome to video 18. This is IAS 33 earnings per share. Now, this is tested in both financial reporting and SBR, but the way it is tested is different. In FR, it is calculation of EPS, and in SBR, the focus is not on the calculation, but rather what is the impact of the error in EPS on your financial performance. Now, IAS 33 applies to all listed companies. Private companies therefore has to follow the standard if they disclose the EPS figure. There are two types of EPS that you should know. One is basic EPS, other one is diluted EPS. Basic EPS is profit or loss for the period, that is for the equity shareholders, divided by the weighted average number of equity shares. The weighted average number of equity shares takes into account when the shares are issued in the year. Diluted is IAS 33 requires diluted EPS to be disclosed as well as basic EPS. So diluted EPS will show the effect on your current EPS if there are potential equity shares that has been issued under the greatest possible dilution. That means, what is the meaning of word diluted? Your EPS will reduce because either you are selling your shares, either you are buying more shares, there has been a change in the number of shares as well as the profit. So EPS reduces. Your basic EPS will always be more than your diluted EPS. Okay. Now, what are the potential equity shares? It consists of these things. Because of these things, there are differences. That means your EPS will be diluted. Convertible loan stock, share options, rights granted under employee share schemes, rights to equity shares that are contingent upon future event. So all these four options, under these four options, you have to calculate diluted EPS. Okay, and the detail of this is explained in my lecture IS 33. Now, example. So an entity has issued 200,000 shares at a full market price on 1st Jan 2005. Date is very important. Number of ordinary shares in issue at 30th June 2005, that is after 6 months, is 1 million. Okay, so if you calculate the difference, how much they have issued, 1 million minus 200,000, 800,000, and the profit is 550,000 for 30th June. Now, to calculate the basic EPS, okay, your weighted average number of shares is this. From Jan to June, that means for the first 6 months, you have 200,000 shares already. Sorry, 800,000. Because you have issued 800,000. So 800,000 for the 6 months. Thereafter, you will be having 1 million. Then from 30th June till December. So 1 million for 6 months. So you add both, it's 900,000. The number of shares. Profit remains the same, 550,000. So 550 divided by the weighted average number of share, which is 900,000. Now your EPS is 0.61. But if there are anything, for example, share options or anything, you have to calculate the diluted EPS as well, which will be less than 0.61. Not very different, but somewhat lesser than this. So thank you for watching, and make sure that you do enough questions on EPS. EPS is usually not asked, not a very frequently tested standard, but whenever it is asked, make sure that you know the calculations, the formulas, because it is highly scoring standard. It's very easy to score marks for EPS if ever you are given. But in SBR, it's more like analysis. You have to do the analysis. What could be the impact of EPS on your performance, position, cash flow? Okay. Now, the next standard is another very important standard, that is IS 36, impairment of your assets. So, see you in the next standard. Assalamu alaikum. Welcome to video 19. This is IS 36, impairment of assets. So, it is very unlikely in your financial reporting and also in your SBR that you will not be given a question where assets are not tested. It could be any kind of assets. Tangible, intangible, financial assets, investment assets. So any type of assets. With asset comes impairment. Okay. So impairment is not separate. If asset is there, it will be impaired. So for that impairment, we are going to go through IS 36, impairment of assets. How you deal with impairment. That makes this standard very important. And what I wanted to emphasize is that this standard is the most important standard after assets. So it will definitely be tested. Okay. Now, impairment is your expense. Okay. So impairment is measured by comparing the carrying amount of your asset or cash generating unit with its recoverable amount. If your carrying amount is more than the recoverable amount, your asset is impaired and you have to write it down to a recoverable amount. And if it's the other way around, when your recoverable amount is more than the carrying amount, asset is not impaired. But very rarely they will give you a question where the asset is not impaired. Most of the time, they always give you a situation where asset is impaired. So, this is a picture. Compare carrying value with the recoverable amount, and recoverable amount is greater of fair value less cost to sell and value in use. Fair value less cost to sell. How will you get it? You will be given the selling price and the cost to sell it. Deduct the direct selling cost from the selling price. Next, value in use. This you have to estimate. Either they will give you the figure or you have to estimate. How? That is the present value of your future cash flow from the continued use of the asset. Okay. So this two things is basically what are you doing? One, fair value less cost to sell. You're finding out what is the value if I sell the asset. Value in use means what is the value if I do not sell the asset and keep using it. So you compare the two, whichever is higher is your recoverable amount. Whether it is better to sell the asset, amount is higher, or value in use is higher, and compare it with the carrying value. Now, there are indicators of impairment. Okay, and these indicators are divided into two categories, external and internal. Now, under impairment review, see, unless an impairment review is required by another standard, for example, IS 38 or IFRS 3, then your impairment review will only be required if there are indicators of impairment. But intangible asset and business combination, you always have to review for impairment. That's what they say, whether there are indicators of impairment or not. Other than these two standards, all the other standards require you to do the impairment review annually when there is an indicator of impairment. So now let us go through the impairment indicators. First, external. Competitive actions. Increasing interest rate, which can affect your value in use, because your value in use, you are using that interest rate to discount, right? Higher the interest rate, lower your value in use. Then market value of asset is falling. Change in the business of the market where assets are used, for example, government actions. What is the difference between internal and external indicator? External is something external, beyond your entity, outside your entity, not in your hands, not in your control. Now, internal indicators: physical damage to the asset, management committed to reorganize business, obsolete asset, ideal asset, major loss of key employees, operating loss in the business where the assets are used. Remember, these are inside the organization. But you can extend the life of the asset by repairing the asset frequently, by buying a new asset, by not keeping the asset idle, by retaining the key employees. You can somewhat have a little bit control over the internal indicators, but external indicators is beyond your control. Now, CGO, that is about asset. Sometimes it is not, you are not able to identify that this particular asset has been impaired when the asset is a part of a large group. So then you compare the cash generating unit where you pull all the assets, okay, that generates independent cash flows. So in this case, you have to find how are you going to do the impairment review. So, or not always possible to base the impairment review on individual assets, as an individual asset cannot generate distinguishable cash flow. In this case, the impairment calculations will be based on your CGO, where you will group all your assets together and then find out the carrying amount and the recoverable amount, compare them and find the impairment. So the impairment calculation is performed by comparing carrying amount of the CGU to the recoverable amount of the CGU. This is achieved by allocating the entity's asset including goodwill to CGU. Now, impairment loss are allocated to asset with the specific impairment first. Whichever specific asset has been impaired, first you will allocate the impairment loss against that. Then you will allocate in the following order: first against goodwill, second against other assets on a pro rata basis. Remember, assets can never be written down below the higher of fair value less cost to sell, value in use, and zero. You cannot write down more than this. Now, how do you recognize impairment loss? Assets that are held at cost. If you are using a cost model, then your amount of impairment will go in your statement of profit and loss. Okay. If it's a revalued asset that has been impaired, then your impairment will first be charged to OCI to reverse any previous surplus on that asset in the same way as a downward revaluation. Then further impairment will be charged to profit and loss. Same way how a downward revaluation works. To know more about downward revaluation, you can watch out my IS 16. Okay. In the same revision series, under the revision series itself, you have to go to IS 16. There I've explained how downward revaluation works. First, against OCI, if you have to reverse any surplus, then balance from the statement of profit and loss. Now, example, your CGU has a carrying amount of 150, recoverable amount is 132. So clearly you know the difference is the loss because carrying amount is more. So there has been impairment loss of 18 million. Okay, these are the net assets. Goodwill 10 million, property 20 million, plant and equipment 45, and net monetary asset 15. There are asterisk marks next to property. Property has a market value of 25 million. So cost is 20, market value is 25. And your net monetary asset will be realized in full. This is the question. Now the solution. So the impairment loss of 18, you cannot set them against the property or the net monetary asset because these assets are not impaired. They told, right, net monetary asset has been realized fully. And also property value has been increased from 20 to 25. So those two assets are not. The remaining assets are goodwill and your other asset, that is goodwill and plant and equipment. So first you will allocate against goodwill. So goodwill amount is 10 million. So if you allocate against goodwill, so from 18, 10 million will go to goodwill. What is the impairment loss that is remaining? 8 million. So the remaining 8 million impairment loss you will set off against the plant and equipment, not fully, in proportion to their carrying amount. So thank you for watching, and make sure that you do questions on IS 36 from your revision kit, both for FR and SBR students. There are plenty of questions on IS 36, which is a good way for you to know how IS 36 could be tested. But IS 36 is definitely tested. That's for sure. So thank you for watching, and I shall see you in the next standard. Again, a very important standard and a very frequently tested standard, which is IS 37. Provision, contingent asset and contingent liability. Thank you. Assalamualaikum. Welcome to video 20, IS 37. So in IS 37, there are three things that we are going to account for: provision, contingent liability and contingent asset. A standard which always comes in almost all the exams, both for SBR and FR. So a provision is a liability of an uncertain timing or amount. Provision must be recognized when entity has a present obligation as a result of past event, probable that outflow of economic benefits will result, and reliable estimate of the obligation can be made. Okay, so the amount that is recognized as a provision is the best estimate of the expenditure that are required to settle the provision. When the time value of money is material, you have to discount your provision to the present value. And where the time value of money is not material, you don't have to discount. Mostly it is material, okay, that's an assumption, and we discount the provision to the present value, and they will always give you the discount factor. You don't have to worry at all. Now, IS 37 is giving specific guidance in several areas. Provision for future operating loss. So they say provision for future operating loss you cannot recognize because they do not result as a past event. Okay. Next, a restructuring provision. Restructuring provision you can only recognize when an entity has a constructive obligation to carry out the restructuring. That means they have a detailed formal plan in place and also they have informed the affected people of the construction plan. Then only you can recognize a restructuring provision. Okay. So how do you know that there's a detailed formal plan that is taking place? For example, you have mentioned what is the location, what is the function, what is the number of employees who will be made redundant. When the plan will be implemented, you are setting the date, the time, and the expenditure that has been incurred. Okay, and you're announcing to the people who are going to get affected by this plan. Next, a decommissioning provision. You have to recognize it in relation to the asset when there is an obligation to remove the asset after the end of its useful life and restore the site to its original state. Often you will see this decommissioning provision. Okay, for example, oil rig or nuclear power plant. Now, so from provision, let's move on to the next, which is contingent liability. Contingent liability is a possible obligation that can arise from past event and whose existence will only be confirmed by an uncertain future event which is outside the entity's control. Contingent liability should not be recognized. Okay, you will only disclose if there's a possibility of transfer of economic benefit. But if the possibility of transfer of economic benefit is remote, you disclose it. You only disclose it. But if it's not remote, if it's very likely that there will be a transfer of economic benefit, then you have to recognize the contingent liability. Otherwise, you do not recognize. So you have to see the probability of the transfer of economic benefit. This they will give you in the exam, whether there is a high probability, low probability. Okay. Contingent asset. Contingent asset is also a possible asset that arises from the past event. Existence will be confirmed by the uncertain future event outside the entity's control. Contingent asset should not be recognized. We usually do not recognize contingent asset, like how we recognize contingent liability. So if the possibility of inflow of your economic benefit is probable, that means you are very sure that you are going to receive the benefit, then only you disclose the contingent asset. Okay. Now, example 1. So a company is making an announcement to its employee that they intend to restructure. They are involving redundancy to be made in one department and other restructuring costs to be incurred. So the announcement was made on 28th March 2005. Company has the year end 31st March 2005. That means before the year end they have made the announcement. Now, in this case, a restructuring provision should be recognized because the announcement was made before the year end. So it is a constructive obligation now that you have to restructure. Example 2. Company is publishing their annual report. Okay. Publishes in its annual report their impact on the environment and the actions that they are taking to minimize the damage. So the company has a well documented record of taking full responsibility. On 1st October, company has brought a machine into use at the cost of 10 million. Now that machine is causing damage to the local land. So the cost of repairing it is 2 million. Machine has to be disassembled and decommissioned on 30th September. Interest rate is 8%. Okay, so now what should you do? You have to find the present value. Okay, this is when from 1st October 2004 to 30th September 2007. For 3 years you have to discount the cost of repairing, that is 2 million at 8%. So this is how you do it. Okay. First, understand whether you have to recognize a provision or not. In this case, you have to recognize a provision. Why? Because bringing the machinery to use and causing the damage to the local land are result that the machine are being operational. Okay, they are operational. This is a past event. Company is well documented also. That means it is creating a constructive obligation that they have to repair the damage. Therefore, you have to recognize a provision. When you first brought the machine into use, whatever the damage has been caused, you have to recognize a provision to that amount. That amount of the damage is 2 million. Interest is 8%. This is to the power 3, not 1.083. It is 1.08 to the power 3. So the provision is 1.59 million. Okay. So the cost of provision will be debited to your property, plant and equipment as the part of the cost of that asset. Remember, it will increase your cost of property, plant and equipment. And each year, your provision will be unbound to increase the carrying amount of the liability, and an interest expense will be recognized in the statement of profit and loss. See, like any liability, provision is what? It's a liability. So that liability you have to find the interest also. So every year, that provision will increase by the interest liability expense. How do you get that interest expense? Same rate that you have used to discount, 8%. That 8% you will apply on your present value, that is 1.58 is your amount of provision multiplied with 8%. The amount that you get is your interest expense that goes into your statement of profit and loss, and also you have to add it with your provision, which will increase your carrying amount. Okay, so you keep on adding like this, 8% with 1.59 for the first year, second year, third year. At the third year, your value should be 2 million, and 2 million is your future value. Okay, now any further damage that is done in the subsequent period, you can only recognize once the damage has been caused, as future damage can be avoided. See, you have to have the damage. You can't write a provision for future damage that is going to occur. It has to have occurred first. Without the damage being caused, you can't recognize it. Why? Because future damage you can avoid if the machine is decommissioned before 2007. Because as such, there is no present obligation. Because no present obligation, no provision. Now, example 3. So it's about company's warehouse being damaged in a fire.
Now, company is making a claim that its insurance will cover the cost of repairing the warehouse and replacing the assets that are damaged in the fire. So at the year end, company has not received any confirmation from the insurance company whether the insurance claim will be successful or not. And there is no reason to assume that the claim will not be paid. So in this case, until the insurance claim, see what is your insurance claim? It's a please understand the nature of the item, whether it's a provision, contingent asset or liability. This is something that you have to receive, insurance claim. So it's an asset for you. So it's about contingent asset. So until you are virtually certain that you are going to receive the insurance claim, you can't recognize a contingent asset in the statement of financial position. Okay. If it is considered probable that the claim will be settled, you can't recognize, but yes, you can disclose it in the notes. The contingent asset, detailing the amount that you expect to receive from the insurance company. Now, exam kit questions that you have to do, these are the 4 questions that you can do: Meheran, Colette, Rugul and Wink. Thank you for watching, and make sure that you do enough questions on IS 37. You will get a lot of questions on IS 37 from your past papers, and also revision kit questions. And I shall see you in the next standard, that is IS 38 Intangible Asset.
Assalamu alaikum. Welcome to video 21, IS 38 Intangible Asset. Another standard on assets, but this is intangible. So you will see some similarities with IS 16 in the standard, and very important standard because this standard is also very frequently tested standard. So in IS 38, IS 38 says that an intangible asset is something which you cannot touch, but it's a identifiable non-monetary asset. Now, initial recognition. You initially recognize intangible asset at cost if all of the following criteria are met. It has to be identifiable, number one. That means you can sell it without disposing the business at the same time. Next, it is something that is controlled by the entity. Something where entity has the power to get benefit from out of it. For example, if you are having a patent, copyright, they will give you some benefit. But these are intangible assets. Next, it has to generate future economic benefit for the entity. For example, either it will help you to reduce your cost or increase revenue. If all of these 3 are met, you will recognize intangible asset at cost. And also cost has to be measured reliably. If intangible asset does not meet the recognition criteria, then it will be taken as an expense in your statement of profit and loss. Items that do not meet the criteria are internally generated goodwill, brand, mastheads, publishing title, customer lists, research, advertising, startup costs, and training. Why? It's very difficult to get a market for this. These assets are very unique. For example, goodwill that you have created, not the goodwill that you are buying when you are buying another asset or buying a company, the goodwill that you are getting. No, something that you have internally generated. It's very difficult to put a value on that. So the cost you cannot reliably measure. Therefore, you do not recognize it as an intangible asset. But yes, you recognize this as an expense. Do not recognize does not mean you completely omit or ignore it. You will recognize it not as an asset but as an expense. Now, subsequent treatment. Intangible assets. See, tangible asset we depreciate over the useful life. Intangible asset we amortize over the useful life. But except goodwill. Goodwill we do not amortize. Okay. So when it comes to intangible asset, very important is you have to see whether your useful life is indefinite or finite. Okay. If it's finite, that means fixed number of years, you have to amortize over that. But if useful life is indefinite, you do not amortize it. Rather, you do annual impairment review, irrespective of whether there are indicators of impairment or not. And indicators of impairment I've covered in my previous video, that is IS 36. You can go and watch that. So intangible asset can be revalued to fair value if there is a active market for it, because finding an active market for tangible asset is easy, but intangible it is difficult because intangible assets are unique products. So it's very difficult to find an active market. Active market is a market where there are homogeneous products. Homogeneous means products are same. You will not have a unique product. Almost all products are same. There are lots of buyers and sellers. So it's very easy to get a price for that. So in practical terms, most intangible assets are valued using cost model. Now, research and development. Recognition of internally generated intangible asset. You have to split into two phases. Research phase, development phase. Research phase is expensed as statement of profit and loss. No question about that. But costs that are incurred in the development phase, you can capitalize as an intangible asset only if it meets this 6 criteria. If it does not meet any of this criteria, it will be taken as an expense in your statement of profit and loss. Okay. First, project has to be technically feasible. Second, asset has to be completed, then used or sold. Your entity should be able to use or sell the asset. Asset has to generate future economic benefit. Entity has a educate, technical, financial, other resource to complete the project, and expenditure on the project can be reliably measured. If these 6 criteria are met, you recognize it as an intangible asset. If one of these criteria are not met, it will be expensed. Now, you amortize development costs. So if you capitalize your development costs, you have to amortize it. So amortization of development costs will occur over the period that benefits are expected. Example, let's say a company has incurred 100,000 on initial design work for a new product. So it is anticipated that design will be taken forward over the next 2 years to be developed with a view to production in 3 years time. So 500,000 they have spent on testing another product. Now, testing is successful. Development team are confident that product will go ahead and it will become a commercial production in 3 years time. So what happens? Now, the design work, that 100,000 that you have spent, you cannot recognize it as an intangible asset. That will go as an expense because it is a research cost. But at this stage, you do not have enough evidence to say that your design will be technically feasible or asset will be able to sold or generate future economic benefit. What about the cost of 500,000? This is at the development cost. This is the development cost. Okay, so in this case, because the testing is successful, which indicates product is technically feasible, so company is also moving the product into commercial production in the near future. So, which they would be unlikely to do if it was unlikely to generate future economic benefit. That means they are more likely to give economic benefit also. So it's most likely to be capitalized as an intangible asset. This development cost of 500,000 rather than expense because it is meeting the criteria. Thank you for watching, and I shall see in the next standard. Again is an asset, a standard on an asset, that is investment property, IS 40. Now make sure that you do questions on IS 38. Assalamualaikum. Welcome to video 22, IS 40 investment property. Once again, this standard is tested in both SBR and FR. So, IS 40 defines investment property as those property which earns rental or from capital appreciation. So if the land or property is held to earn rent or for capital appreciation or both. Remember, the property, plant and equipment that is used in the business is accounted under IS 16, but if it is used for investment purpose, for example, to get revenue through rent or when the capital amount of the property increases, you sell it. That's an investment property which will be dealt in IS 40. Therefore, the users of the property will help you to decide which standard you have to use, IS 40 or IS 16. Now, investment property is not an owner-occupied property that we have just covered under IS 16. Property held for sale in the normal course of business is not an investment property. It will be dealt under IS 2 inventory. I've finished both IS 16 and IS 2. Next, property that is being constructed for third parties will be dealt according to IFRS 15 revenue. Then property that is leased to another entity will be dealt under IFRS 16. So the accounting treatment. Here, entity can choose between cost model or fair value model. The cost model under IS 40 is the same as the cost model in IS 16. Fair value model requires the investment property to be recognized in the statement of financial position at fair value. The gain and loss from the revaluation will go in the statement of profit and loss. That's the only difference. Why? Because under IS 16, revaluation gain goes to OCI and revaluation loss goes to profit and loss. But here, whether it's gain or loss from investment property, it will go in statement of profit and loss only. Now, one example. A company has purchased a property for 1 million, land component is 400. Expected useful life is 50 years. Property had a market value of 1.1. Property is not occupied by the company and it has been purchased for the investment. So now it's an investment property. Okay. So now what happened? What is accounting treatment? Using the cost model. Remember, you have to take the land out because we do not depreciate land. So the total 1 million, you have to take the land out, which is 400. So the cost of the property is only 600,000, which you will divide over 50 years. Your depreciation will be 12,000. Okay. So that 12,000 you will deduct from 1 million and get the carrying amount in the statement of financial position 988,000. Under the fair value model, okay, you will recognize the property at 1.1. So from 1 million at 1.1, what is the gain? 0.1. That 0.1 million gain will be recorded in your statement of profit and loss. Investment property are not depreciated. Okay. If the company purchase any further investment property, you have to account it using the same basis. Okay. Thank you for watching, and I shall see you in the next standard, that is IS 41, that is agriculture. So with this, I have finished almost all the standards that is relating to non-current assets, both tangible and intangible. They are IS 16, IS 38, IS 40, IS 23 borrowing cost, government grant, IS 20, 23, IS 16, IS 38 and IS 40. All these 5 standards focuses on measuring non-current asset, whether to capitalize or not. And if it is capitalized, cost model, revaluation model. So that's the major theme. Now, see you in the next standard. Assalamu alaikum. Welcome to video 23, which is IS 41. This is a very short standard and not often asked in your exam, both for SBR and FR. But if it is asked, you should be in a position to know how it is accounted for. So IS 41 is a biological asset, okay, which is a living plant or animal. Biological asset is a living plant or animal. Agricultural produce is the harvested product of the entity's biological asset. Biological asset, you have to measure using fair value less estimated cost to sell, and it has to be revalued each year end. So any change in the fair value will be recognized in the statement of profit and loss, same like your investment property. At the date of harvest, agricultural produce should be recognized and measured at fair value less cost to sell. It is then accounted for under IS2 inventory. Example, a herd of goat has a fair value less cost to sell 1000. Goat was purchased for 250. So the fair value at 31st December is 1450. Now you have to find out the gain or the loss. So you see, first fair value less cost to sell is 1000 and you have purchased another goat for 250. So 1250 and the fair value was 1450. So it has increased from 1250 to 1450, from 1250 to 1450. The difference is 200. That 200 is the gain, which will be recognized in the statement of profit or loss. So that's it for IS 41, and I shall see you in the next standard, that is IFRS 1. That is when you adopt the IFRS for the first time. What is the impact? With this, I have finished all the standards that are IS. Now I'll be focusing on the IFRS standards. Okay. So thank you for watching. Assalamu alaikum. Welcome to video 24. IFRS 1, first term adoption of IFRS. This is applicable only for SBR students. It's not there in the FR syllabus. So this is for those entities who have adopted IFRS for the first time. Okay. Now, the date of the transition is the beginning of your earliest period for which an entity is going to present full comparative information under IFRS standards in its first IFRS financial statement. IFRS 1 requires entities to prepare an opening IFRS statement of financial position at the date of transition. This statement must recognize all assets and liabilities that are required by IFRS, not recognize assets and liabilities not permitted by IFRS, reclassify asset liability equity in accordance with IFRS, measure all assets and liabilities in accordance with IFRS. Any gain and loss, because now you are adopting IFRS, will be recognized in the retained earnings. Now, the exam kit questions on this area is white book. That is the only question. Not much question is tested for IFRS 1, and IFRS 1 also does not very frequently come. It has a less chance of appearing. Okay. So thank you for watching, and I shall see you in the next standard. The next standard is a very important standard for SBR students. It's not there in your FR syllabus, but is there in SBR, which is IFRS 2 share-based payment, and also is a very technical standard. So see you in the next video. Assalamualaikum. Welcome to video 25, IFRS 2 share-based payment. This standard is only applicable for SBR students, and it's a technical standard, and it has a very high chance of appearing in your SBR exam since it's newly asked in SBR, not asked in FR. So a share-based payment is a transaction in one where an entity obtains goods and service from other parties with payment taking in the form of shares or share option. That means rather than paying in cash for buying goods and services, you are paying them in shares or share options. There are two types of share-based payment. First, equity settled. Next, cash settled. Equity settled share-based payment when an entity receives goods and service in exchange for equity instruments. That means shares or share options. Cash settled means entity is receiving goods and service in exchange for a cash amount that is paid based on the share price. Now, in your exam, you can be asked any of the two: equity settle, cash settle, or both in same question. Now, the accounting treatment. If an entity issues share options to their employees, so that means, see, for example, your employees are working for you. What are they doing? They are giving you a service, okay, by working there for n number of years. Rather than you paying them only in cash by giving them salary or wages, you are paying them share options in your company or shares. So that is share-based payment. Okay. So how do we account for that? Entity, if an entity issues share options to employees, then you have to take the fair value of the option at the grant date. That will be used as the cost of your service that is received, not at any other date. For cash settled, the fair value of goods and services will be measured and a liability will be recognized. Remember, with cash settled, liability. Okay. The liability is remeasured at each statement of financial position date until it is settled with the changes in value being taken to statement of profit and loss. That means any change in the fair value, gain and loss will go in the statement of profit and loss. The expense in relation to the share-based transaction must be recognized over the period in which services are rendered or goods and services are received, which is known as vesting period. That means, let's say you, an employee, have been there for 5 years. So over the 5 years, you will recognize this share-based transaction, which is an expense. You will recognize for the 5 years it as an expense of giving shares to your employees. This is from the employee's perspective we are talking. Okay. Now, grant date. Some keywords are very important when it comes to IFRS S2. Grant date. The date a share-based payment transaction is entered into. Vesting date. The date on which cash or equity instruments will be received by the other party to the agreement. Example. A company is granting share options of 5,000 shares that is due to vest in 5 years' time. Fair value of the option at the date of the grant is $3. So now you are assuming that you will be there for the 5 years and you will take up this option. So how are you going to find the fair value? At the grant date, which is given as $3. So 5,000 into $3, 15,000. This 15,000 you will spread over the vesting period. How many years are there? 5 years. So this 15,000, okay, you will vest over 5 years. That is 15,000 divided by 5, 3,000. So every year you are going to record 3,000 in your statement of profit and loss as an expense. Each year, and each year the cost has to be remeasured to take any adjustment in that remeasurement will be taken to statement of profit and loss. And the entry side, okay, you have to credit the equity. The credit entry will be in the equity for the share options. Now, at the end of year 2, what is happening? Only 4,000 options will vest, let's say. Then how do you account for it? So the total cost of the scheme, 4,000 into 3, the fair value of the grant date, which is 12,000. Okay. Now, this 12,000 you have to take into 2 divided by 5 because total vesting period is 5 years, but you are in the second year. So into 2 divided by 5. So a cost of 4,800 will be recognized. in year 2. Since you have recognized 3000 in year 1, now your cost increased to 4800. Only the difference you will recognize in year 2. That means from 3000 it has increased to 4800. The difference is 1800. So in year 2 you will only record 1800. The difference, not total 4800. Okay. Now, assuming there are no further changes in the number of shares that are expected to vest, 2400 will be charged to your statement of profit and loss in years 3 to 5. Okay. Now, exam kit questions are Margie, Luploid, Semple. Thank you for watching, and make sure that from your SBR revision kit you have to do questions on IFRS S2 because it's a technical area and students often struggle in IFRS 2. Okay, so make sure that you do lots of practice in this area. Now, the next standard is a favorite topic, that is group accounting, which is IFRS 3, that is business combination, which is needed for your group accounting, applicable for both FR and SBR students. So let us go to the next video, which is IFRS 3. Assalamu alaikum, welcome to video 26. This is IFRS 3 business combination, and this standard comes in your group accounting. So that means this standard is definitely going to come because you're always tested on group accounting, that is consolidation. So in IFRS 3, when you acquire a subsidiary, there are three things that matters. Your purchase consideration, the amount that you are paying to acquire that subsidiary, your net asset, and your NCI, non-controlling interest. Because with this three, you can get your goodwill, which then later you will impair and you will record in a statement of financial position. So your purchase consideration and your net asset will be recorded at fair value. Fair value is the price that you would receive to sell an asset in a transaction between market participants at a date. And the details of how fair value is measured is given in the IFRS 13, which we'll discuss later. Now, first is the purchase consideration, which is measured at fair value. But the amount that you pay to acquire your subsidiary could be anything. Not necessarily it has to be in cash. It could be in shares, it could be in contingent consideration, deferred cash. Okay, and how do you measure the fair value of each of them? So first, in your exam, always check what are the various types of purchase consideration. You might be given one type in cash, which is very easy. Just take the amount and record it. But if it's not cash, if it's in other ways you are paying, you have to know how to find the fair value in each of them. First, deferred cash consideration. Deferred cash considerations, you will be given a discount factor because you have to discount it to the present value using the rate given in the question. Okay, and that rate is the rate that you will use to borrow. Okay, deferred cash consideration. The word deferred says you are going to pay the cash later. You're going to defer it. That's why we have to find the present value now. Next type of consideration is shares, where you are giving your own shares to acquire the shares in the subsidiary. Here, you have to look at the market price at the acquisition date when you want to find the fair value of the acquirer's own share. Third, contingent consideration. Contingent means it is based on some condition. Okay, which you, if this is that, then this will be the value. Remember, you have to find the value of contingent consideration even if the payment is not probable. Now, non-controlling interest. Non-controlling interest often you will not be given in the exam directly. But for example, question says you have acquired 70%. So your NCI will be 30%. Okay. So NCI could be measured using two ways. First, fair value. Most of the time in the exam, they will give you the fair value. But if they don't give you, you have to know how to find the fair value, which is the number of shares owned by NCI multiplied by the share price. That is subsidiary share price, or NCI's proportionate share of the net asset. Here you have to find the NCI percentage, multiply it with the fair value of the net asset at acquisition. Okay. Remember, the two figures will give you different figure. Okay. The two methods. The first one, fair value, is known as full goodwill method because it includes both NCI's holding as well as the parent's holding. The next, proportionate share, will only include the parent's share there. Okay. It is known as partial goodwill or half goodwill method. And the goodwill that you calculate will be different under both this method, because your NCI differs means goodwill will be different. And finally, we have arrived to goodwill. So what is goodwill? Goodwill is when your amount that you are paying plus your NCI is more than the net asset, is your goodwill. Okay, goodwill could be both positive or negative. Positive, it's normal, because normally your amount that you are paying plus NCI, it will be more than net asset. That is a common scenario. So this positive goodwill, since goodwill is a non-current asset and it's an intangible asset, you have to capitalize it. So goodwill will be capitalized as an intangible non-current asset, and like any intangible asset, you have to do an impairment, even for current assets. Sorry, even for tangible assets. But the only difference with goodwill compared to other intangible non-current asset, we do not amortize goodwill. We never amortize goodwill. Rather, we test it annually for impairment. And this impairment charge will be recorded as an expense in your consolidated statement of profit and loss, not single statement. Why? Because this goodwill arises because you have acquired the subsidiary. So in your consolidated statement of profit and loss, you will record impairment. Now, the next scenario, which is not very common, rarely, in practice also it's rare, and in your exam also it's a rare situation, but if it ever comes, you should be able to know how to deal with it. This is when your net asset is more than the fair value of your consideration. Then it's a gain. Why gain? Because you are paying less. You are paying less than what is the worth of the net asset. So for you, it's a gain, known as negative goodwill. If negative goodwill arises, first thing you have to check your calculation, whether it's done correctly or not. Why? Because sometimes what happens when your calculations are incorrect, you might get a gain, but actually it's not a gain. So first check the calculation. After checking the calculation, if still it's a gain, that means it's a gain, and you will record it as an income in your profit and loss. So it will be credited to profit and loss. Okay. Now, these are some other adjustments that arise when you are making intra-group transfer between the parent and the subsidiary. Remember, these adjustments do not apply to associates and joint ventures because they are not part of a group. But if it's with subsidiary, they are part of a group. So all these adjustments, if any transactions happens within the parent subsidiary or subsidiary and parent, eliminated on consolidation. Yes, in separate financial statements, you have to record, but in consolidation, ignored, eliminate. How do you do that? So, interest on intra-group loans, you do not recognize it as an income or expense. Neither, you eliminate it. Intra-group management charges, intra-group sales, purchase, unrealized profit in inventory, intra-group transfer of non-current assets, unrealized profit on transfer, intra-group receivable payable loan, eliminate. Now, let us understand this through an example. P has purchased 100% in S for 1.8 million. 100% means there is no NCI. Okay, for 1.8, 1.8 is your purchase consideration. Net asset carrying amount is 1.35, but the fair value is greater. Okay, so the fair value of S net asset was 150,000 greater than its carrying amount. What do? Increase the net asset by 150,000. So 1.35 million plus 150,000, if you add, it is 1.5 million. So now you will compare purchase consideration of 1.8 with the net asset 1.5, difference of 0.3 is your goodwill. Okay, thank you for watching, and I shall see you in the next video that is going to talk about IFRS 5 non-current assets held for sale and discontinued operation. Now there are plenty of questions on consolidation. All you have to do is just go and do it right now. Even though we have not covered all the standards, there are still a few standards are remaining for group accounting: IFRS 10, IFRS 11, and IFRS 12. But even with IFRS 3, you will be able to do group accounting questions. Thank you. Assalamu alaikum. Welcome to video 27. This is IFRS 5, non-current assets held for sale and discontinued operation. This is applicable for both FR and SBR students. Now, what is a discontinued operation? A discontinued operation is a component of an entity that either has been disposed or is classified as held for sale, and it represents a separate major line of business or geographical area of operation. part of a single coordinator plane to dispose a separate major line of business or geographical area, subsidiary acquired exclusively with a V2 resale. All these things, either they are classified as held for sale or they are discontinued operation. IFRS 5 says that a non-current assets that is held for sale, okay, you have to measure it using the rule of IFRS 5 if it is held for sale. Now, disposal group. What is a disposal group? See, either you are disposing a non-current asset or you are disposing a disposal group. Disposal group means it's a group of assets. With it, you have liabilities also, which you are going to sell together in a single transaction, not in installments. In one single go, you are going to sell all these assets. That's why it's known as disposal group. Okay. So asset can only be classified as held for sale. See, in IFRS 5, this is that key area which is likely to be tested if ever they ask you IFRS 5. IFRS 5 is not asked in every exam, but you can say it is asked in, you can say the way it is asked is in moderation. Not too much also, not too less also. Okay. This criteria that when it can be classified as held for sale, this criteria can be tested. Okay. If they meet all of the criteria, not just one, all the criteria if they are meeting, it is classified as held for sale. First criteria, management has to have a commitment that they have to sell. Next, the asset or the disposal group is available for immediate sale in its present condition. You don't have to do too much change. Okay, you don't have to wait too long before selling it. In whatever the condition it is, you can sell it immediately. Third, sale is highly probable and it is expected to be complete within a year from the date of classification. Next, the asset is actively marketed for sale at a reasonable price compared to its fair value. And it is unlikely that there will be a significant change which will make you to withdraw your plan. That means you will not back off. Once you have made the decision you are going to sell, you will sell it. So if these 5 criteria are met, your asset is classified as held for sale. Remember, it will no longer be recorded under non-current assets. It will become under your current assets. So if the criteria are met after your statement, after the statement of financial position date, but before the accounts are authorized for issue, asset will not be classified as for sale, but you will rather disclose this information because this is after the statement of financial position date you are meeting the criteria. Okay. Now, how do you measure? You will measure an asset classified as held for sale at the lower of its carrying amount and fair value less cost to sell. So first you will take the carrying amount, compare it with the fair value minus cost to sell. Whichever is lower, that is your amount that you will take. Asset classified as held for sell, you will not depreciate them because they become a current asset now. It doesn't matter whether you are still using that asset in the organization or not. You will not depreciate it. Now, how do you present? IFRS 5 says information about discontinued operation. Either you can present on the statement of profit and loss as a single amount. So this compromises profit or loss from discontinued operation. You will often see in your statement, profit and loss statement, that there is one line that says profit or loss from discontinued operation. And often this line comes after profit and loss from continuing operation. Remember, whenever you have a discontinued operation, you have to write profit and loss from continuing operation and discontinued operation separately. Okay. Any gain and loss because you are doing fair value. And when you have any fair value under any standard, you always have to, what do? Remeasure. So because of that, there will be gain and loss because of the changes in the fair value. This will not come when you're measuring at cost. This only comes for all those standards where fair value is used. And almost always, all the IFRS standards, you will see fair value is used. Cost value, very rarely. Subsequent measurement is mostly fair value. So gain or loss on the measurement to fair value less cost to sale or on the disposal of the discontinued operation, you will record in the statement of profit and loss. These are the exam kit questions for SBR students that they have to do. Okay, that is Corwell, Larius, Skyzer, MC, Bismuth, Symbol, Colette, Agency Group, Renshu, Bohai, Jesse. Now, let me tell you, all these questions are not on IFRS 5. And IFRS 5 is the last standard that is going to cover non-current asset. Because before this, I've covered the other standards which is covering non-current assets. They are IS 16, IS 20, IS 23, IS 40, IS 38, and now IFRS 5. So all your investment property, intangible asset, non-current assets held for sale, borrowing costs, government grant, all these are various type of different assets. So all the standards are covered in this question. It is not just IFRS 5. That's why you will see there are so many questions. So that's why it's best to do all these questions for you to get a handover in your non-current assets section. With this, I end this video here. Thank you for watching, and I shall see you in the next standard. Again, a very important standard because it is relating to another major standard which will come later up, which is IFRS 7 financial instrument disclosure. So thank you for watching. Assalamualaikum. Welcome to video 28. This is IFRS 7 financial instruments disclosure, where we have three separate standards dealing with financial instruments. IS 32 financial instruments presentation that I've completed. Now this one is for disclosure only, and the main standard that is for recognition, measurement, derecognition is the IFRS 9, which will be upcoming. Now, so under IFRS 7, it requires you to disclose two main categories relating to financial instruments. First, information about the significance of financial instrument. Second, information about the nature and the extent of risk arising from financial instruments. Now let me tell you, one might be wondering why there are so many different standards just for financial instruments. But for other standards we do not have, we all have in one standard. The reason is because a lot of fraud that have taken place in the past is due to financial instrument, because this is a very complex area. Users do not understand often how to deal with it, and the risk is also high in this area. Therefore, in order to minimize the risk, the impact on the equity entity, they have brought up separate standards for this financial instrument alone. That's why there are separate, one for presentation, one for disclosure separately, and the other one is for measurement, recognition, and all those things. Okay, so that's why you have to separately disclose under IFRS 7 the financial instruments risk. Okay, next, qualitative disclosure, risk exposure for each type of financial instrument, management's objective policy and process for managing those risks, changes from the prior period. Now, quantitative disclosures are summary quantitative data about exposure to risk at the reporting date, disclosure about credit risk, liquidity risk, market risk. They are not the same. You have to know the meaning of them. Okay, and concentration of the risk. So that's it for IFRS 7. Usually, IFRS 7 is not a question that is asked and not from the point of calculation, because that is done in IFRS 9. If they ever ask you, that is only to say what needs to be disclosed. So only there's two things. One, the financial effect, and the nature and the extent of the risk. So thank you for watching, and I shall see you in the next standard, which is IFRS 8 operating segment, applicable only for SBR students, not there in the FR syllabus. Thank you. Assalamualaikum. Welcome to video 29. It's IFRS 8 operating segment. This standard is not there in your financial reporting syllabus, but it's there for the SBR students. So, IFRS 8 requires an entity to disclose information about each of its operating segment. Now, what is an operating segment? Operating segment is a segment that engages in a business activity for which they earn revenue and incur expense. Results are reviewed by the chief operating decision maker, and for which financial information is available. If these three things are present in a component of an entity, it is called as an operating segment. Okay. Now, what are the reporting threshold that says that if you are beyond this level, you have to disclose? IFRS 8 requires entity has to separately report information about their operating segment if it meets one of the following quantitative threshold. First, sales. Your sales has to be 10% or more of the combined revenues of all the operating segment. Remember, the sales will cover both international and external sales revenue. Next is your profit and loss. If your profit and loss is 10% or more of the greater in absolute amount of combined reporting profit that do not report a loss, and combined loss that report a loss. So whichever of these two, first add all of the segment which is giving a profit, then add up all those segment which is giving a loss, compare the two, whichever is greater, you have to take the 10% of that. Okay, next, your asset has to be 10% or more of the combined asset of all the operating segment. So individually you have to see this line by line if it is meeting the threshold or not. If any of the one threshold is met, it is a reporting operating segment. Sales is more than 10% or more, profit or loss is 10% or more, asset is 10% or more. So everything is 10% or more. The three things are sales, profit and loss, or asset. Okay. Now, this is the next beyond the quantitative threshold that we have just gone through. That is the 10%. This is known as 75% rule. At least 75% of the entity's external revenue should be included in that operating segment. So if your quantitative test result in the segmented disclosure of less than this, then you can bring out your other reportable segment until you reach the 75%. What does it mean? See, for example, you did not report a segment as an operating segment because it did not meet the 10% threshold. But the rule also says that your operating segment has to report at least 75% of external revenue. That means if after adding up all the segment you are not reaching to 75%, those segment which did not come under operating threshold under the 10%, now you can start reporting it so that you reach the 75% threshold. Okay. Disclosure. So for each reportable segment, IFRS 8 has to disclose this. First, the measure of profit and loss, measure of total assets, and measure of total liabilities. Now, the exam kit questions Clan said you have to do. And thank you for watching. And I shall see you in the next standard, which is IFRS 9 financial instruments. The most trickiest out of all the standards in the FR and SBR syllabus. So thank you for watching. Assalamualaikum. Welcome to video 30. This is IFRS 9 financial instruments, which is there in both SBR and FR syllabus. And most of the trickiest area is IFRS 9, which students often find difficult. So therefore, this revision is going to be a great help for those students who find IFRS 9 difficult. Why it's difficult? Because it's too much technical. There are too many technical stuff and too many things to remember. Okay. But what if I say that you don't have to memorize anything at all, and still you will find financial instruments one of the easiest standard? How? You have to watch this video till the end to get your answers. So I'm going to make financial instruments the easiest subject for you. Okay. Now, first, financial asset. So financial instruments, you have to understand there are three separate categories. One is financial asset, two is financial liability, three is equity. Let us first focus on financial asset. Okay. Now, what is financial asset? Anything in terms of, you can say, monetary. They are monetary assets. Anything to do with cash. Okay. Financial asset is an asset which gives you a right to receive cash. Anything which is giving a right to receive cash is your financial asset. Anything which is giving an obligation that you have to pay the cash is your financial liability. Okay. Why financial liability? Because assets could be various type of assets like non-current assets, inventory, intangible assets. These were also your assets that we have gone through. But there you did not have the right to receive cash, that you have to receive a cash. Nor other kind of liabilities like trade payables, provisions, leases, they were also liabilities. But it is not compulsory that you have to, there was not an obligation for you to pay the cash. Therefore, they were not financial assets or liability. Okay. So there were other assets and liabilities which we have categorized into other standards. But all the financial assets, all the financial liabilities, they are grouped together and they are dealt under IFRS 9, known as financial assets and financial liability. Okay. Now, financial assets could be of two types. Either you are investing in an equity or you are investing in a debt. Debt instruments means you are having that debt instrument, you are giving a debt to someone. It's like you are giving a loan to someone. So that loan is a loan for the person who is taking the loan. But for you, it's a financial asset because you're going to receive amount. You are going to receive the principal amount, the amount of the loan, as well as the interest from the person to whom you have lent it. So for you, that loan, that investment in debt is a financial asset. Same goes for equity. If you're having shares in a company, you are going to receive dividend from it. So that dividend is a financial asset. That's why that investment in equity is a financial asset. Okay. That's why it's very important for you to understand the various categories that financial instruments can fall into, because each category are dealt separately. Once you understand the categorization, things becomes very easy. Why students find IFRS 9 difficult? Because when you start studying from day one, you start memorizing the terms, definitions, memorizing the entries, that if this happens, this is debit, this is where it goes. It makes it very difficult, trust me. Okay? Understand the logic, understand the whole process. Then you will understand the recording is also very easy. Okay? Now, so first let us finish investment in equity, because this is easy. Less things to deal with. Investment in debt is a bigger part. There we have so many categories. So first let us finish with investment in equity. And first finish from the financial asset side. Do not study two things together. Once you are pro in one area, then study the other area. It makes it very easy. So do not jumble up with financial asset, financial liability, and equity. That equity and this investment in equity, which we are talking about, financial asset, is different. Okay. So investment in equity. Now, investment in equity instruments. Example, investing in ordinary shares of another entity is your financial asset. Okay. Normally, we measure them at fair value through profit and loss. Okay. See, there are three ways. Before I start the lecture, let me tell you, there are three ways you can measure in IFRS 9 all the financial instruments. One is amortized cost, one is fair value through profit and loss, one is fair value through OCI. Okay, but what goes to each of this, that you need to understand. Okay, like how we measure any asset, we have a cost model, fair value model. Here also we have a cost model, fair value model. That cost model is the amortized cost, and the fair value model is further divided into two, one in OCI, one in profit and loss. Okay, now, so this investment in equity instruments, if you are having, will be measured at fair value through profit and loss. It's like how you put a value for any asset. Same for this also. Fair value through profit and loss. Why through profit and loss? Because any changes in the fair value will be recorded in profit and loss. That's why we say fair value through profit and loss. Okay. So it is possible to designate an equity instrument as fair value through OCI. Provided following conditions are complied with. What does it mean? Yes, we say that it is fair value through profit and loss, but there is an option for you. You can elect the fair value to go through other comprehensive income. This is only for investment in equity we are talking about. But to again do that election, you have to meet the following condition. Without those conditions, if you are not meeting those conditions, it will always be in profit and loss. You can't take it to OCI. Okay. So your equity instrument should not be held for trading. And it is an irrevocable choice for this designation upon initial recognition of the asset. That means once you make this choice, you can't go back. You can't change from one place to another. If you are making the election to be in OCI, it will be forever in OCI. This is only for investment in equity I'm talking about. Why am I emphasizing this point so much here? Because when I go to investment in debt, situation changes, rule changes, then it's very confusing. Students often confuse these two things. Ma'am, you told that it will never be in profit and loss. Why did it come to profit and loss again? Because that is a debt instrument. This is equity instrument. Please understand what it is, what type of financial asset it is. Like non-current asset, we have various type of non-current asset. Property, plant, and equipment is one. Land is one. Then investment property is one. Then intangible asset is one. Same for financial asset also. We have various types. One in investment in equity, investment in debt. Okay. So they will not ask you what are the investment in debt, what are the categories, what are investment in equity category. That they will not ask. Generally, the measurement rule they have told. So in short, investment in equity is fair value through profit and loss. But you can make an election to go into OCI if these two conditions are met. One condition is it is an irrevocable choice. Forever it will remain once you make the election. Then your equity must not be held for trading. If your equity is held for trading, you cannot put to OCI. Think it like that. If you see normally, any profit and loss that is held for trading will go to profit and loss. Same for this also. If it is held for trading, you cannot take it to OCI. What do we take in OCI normally? Recall IS 16. Revaluation asset. When we revalue, that revaluation is not a realized gain. Not that we have disposed and that we have got a gain. It is just on the paper. That gain is just on the paper we are showing. Revaluation gain. So where do we record it? Under other comprehensive income. Mostly your unrealized gain is what we record in other comprehensive income. Something that we have got in cash. We have got the benefit. Realized gain, we record it in profit and loss. Most of the item goes in profit and loss only. And anything for help for trading goes in OCI. But revaluation is something that we do not normally do for trading. That's why it was recorded in other comprehensive income in IS 16. Okay, think like that. So that's why equity instrument, if it is held for trading, it will be in profit and loss only. Then you can't make the election. But if it's not held for trading, then you can make an election that uh, for the fair value to go through other comprehensive income. That's it. Now, that's all about equity investment. Finished. Now, coming to investing in debt. Okay, this is an area which is highly asked. Okay, compared to equity instruments, it is investment in debt which they often test. Why am I emphasizing this? Because whenever the students think debt, they always think themselves from the person of they are the one who is taking the debt. So how is a financial asset? No, no, no. It is you who is giving that debt to someone else. For you is a financial asset. For the person who is taking that debt from you is a financial liability. You understand? Remember, for one party it is financial asset. For another party it has to be a financial liability. Okay, that's how it goes. Normal also. If for you it's an asset, for the other party is a liability. That's how it works. Now, IFRS 9 requires financial assets that are debt instruments can be measured in three ways. These are the three ways that I've talked about. Amortized, fair value through other comprehensive income, and fair value through profit and loss. But remember, amortized cost is not there for investment in equity. It is only for debt. Equity can only be taken fair value through profit and loss or OCI. Only that. But when it comes to debt, there are three options. Amortized cost. Investment in debt instrument is measured at amortized cost. Please understand it this way. How do you record property, plant and equipment under IS 16? Initially at cost. Same. Just this is amortized cost. Why amortized? See, financial asset is also kind of an intangible asset, something which you can't touch, and we amortize intangible asset, right? So from there, this word came, amortized cost. Okay, because you are going to amortize it at the end. The value is going to go down of the debt instruments if you're holding it for a long period. That's why amortized cost. Of course, you don't have to go behind the details and all these things I'm telling you in a way of a story so that it becomes very easy. So you don't have to memorize amortized cost, that this. Okay. So now investment in debt instrument is measured at amortized cost if there are conditions for this also. It is not your choice. Even if they are giving you a choice, you have to meet the condition. If you are in the condition only, you can go by that measurement. Financial asset is held within a business model whose aim is to collect contractual cash flow. Okay. Of course, you are holding that debt not to finance something. It is there for you to collect the cash flow. And this cash flows has to be of two things only: interest and your principal amount of the loan. Could be bond, loan, anything. Okay. It has to be on a specified date, and payment should solely be of principal and interest. Any other payment beyond this, you can't use amortized cost. Okay. So these two things, remember. This is like a deciding factor. Are you meeting this condition? If you are meeting both, amortized cost. If not, then we have to see another way. Another way is fair value through other comprehensive income. See, in equity, just now we went through investment in equity for financial asset. Our immediate is fair value through profit and loss. But when it comes to debt, the choice is between amortized cost and fair value through other comprehensive income. We go to P&L as the last resort. That is the end choice. Okay. Here also, we have to meet the condition. Here, you have to hold the financial asset. Okay. So your objective is to collect cash flow. But one more additional thing is here. You have to sell the financial asset. So you are holding the cash flow. That means you're holding that debt, but not for the entire life of the debt. Maybe before that you are selling the asset. So because before that you are selling the asset, you can't use the amortized cost because you're not holding it forever. So when you are selling it, think it like that. When you sell, you always refer the fair value, no? You don't go by the cost, historical cost. So you can't use amortized cost. We go by the fair value. But that fair value comes in other comprehensive income. Okay? Because that is also not something that we normally do in our trading activity. It is only because when we are selling, There is a change in the fair value. That's why we have recognized in other comprehensive income. Okay. And here also payment has to be principal and interest only. But the only difference is the business model. Always check the business model in the exam. Are you holding it till maturity or you are holding it and then selling it? If you are holding it till maturity, normal cost, amortized cost. If you are holding and then selling later on, fair value through other comprehensive income. Now, the third way. Once you understood those two ways, this is very easy. Any investment that is not measured at amortized also, not measured through OCI also, will go in your fair value through profit and loss. Simple. Now, financial asset part is over. Coming to financial liability. Financial liability, if it's held for trading, they are measured at fair value through profit and loss. Anything held for trading, fair value through profit and loss. Just understand this. Okay. So most financial liabilities are measured at amortized costs. Okay. Now, IS 9 allows the measurement of financial liability at fair value rather than amortized cost. If doing so will eliminate or reduce an accounting mismatch. For example, the change in the fair value of the financial liability is due to a change in the credit risk. This will be recorded in other comprehensive income, correct? So because you are recording it in other comprehensive income, then the balance of any change in the fair value is recorded in profit and loss. So rather than going for amortized cost, you are recording it in profit and loss. You understand? Since you are recording the change in the fair value of the credit risk in other comprehensive income, any change in the balance of the fair value, that means not due to credit risk, you will record it profit and loss rather than at amortized cost. So you are changing from amortized to fair value. This is one example why you want to change. This only you will change when you want to reduce an accounting mismatch. See, for example, one thing you are measuring in OCI, and on the other side you are measuring it at amortized cost. It's an accounting mismatch. So bring it in profit and loss. Okay. Now, so that's it for financial liability. We only have amortized and fair value through profit and loss. We do not have fair value through OCI. Now, impairment of financial assets. Like any asset, intangible, tangible, it gets impaired. Same financial asset also will get impaired. But impairment for financial liability, we do not study. It's only for financial asset, okay? And by the way, impairment was covered under IS 36, but that is impairment for other assets. But since impairment of financial assets separately it is covered in IFRS 9, so whenever financial asset gets impaired, we are not going to follow the rule of IS 36. We are going to follow the rule of IFRS 9. Okay. But before that, you have to go through some definition, some keywords. First is credit loss. Credit loss means if there is any difference between the contractual cash flow and the cash flow that entity expects to receive. That means if they are receiving less than what they is owed to receive, it's a credit loss. Okay. Then entity expects to receive discounted at the original effective interest rate. Lifetime expected credit loss. What is this lifetime expected credit loss? The expected credit losses that result from all the possible default event over the expected life of your financial instrument. 12-month expected credit loss. This expected credit loss results from default event within the 12 months of the reporting date. Okay. Now, loss allowance. So we have finished the definitions. Now let's go to loss allowance. Like any asset, when it gets impaired, we have allowance. So for same for financial asset also loss allowance. Loss allowance we have to recognize for financial assets that are debt instrument. Why debt instrument? Why not equity instrument? It is debt instruments that normally gets impaired. Maybe you are not able to pay back, sorry, because you are giving a debt to someone. See, dividends irrespective of whether you are able to receive or not, whether profit is there, you will get it. Okay? There is no such thing. But when it comes to debt instruments, the other side of the party might not pay you. So it's a loss for you. Okay? They might become bankrupt. Their company might become insolvent. Whatever the case is, there is always a credit risk that they might not pay you. They are your creditors. So that's why for debt instruments, we recognize loss allowance. And we measure them at either amortized cost or fair value through other comprehensive income. That means we either keep it till the maturity, then amortized cost, or we keep it and then sell it. Fair value through OCI. Fair value through profit and loss will not be tested here. So if your credit risk on the financial asset did not increase significantly since you initially recognized your financial asset, then your loss allowance will be equal to the 12-month expected credit losses. So this they will give you in the exam. Okay, 12-month expected credit losses, what is the lifetime expected credit losses. You just have to know what to take an inverse situation. If your credit risk increased significantly from the initial recognition, then your loss allowance will be equal to lifetime expected credit losses. You understand? So it's about credit risk increasing significantly or not. If not significant, 12 month, if significant, lifetime. That's it. Adjustments to the loss allowance will be credited to the statement of profit and loss. Okay. Like how we adjust provision, under provision, over provision, how we adjust bad dates for receivable, we recognize in profit and loss. Same way, loss allowance for financial asset also will record in profit and loss. Now, why adjustments? Because your loss allowance can go upwards, downwards. Okay, if it's going downwards, it's credited in profit and loss. If it's going upwards, that means more loss allowance, it will be debited. Now, measuring expected losses. So an entity's estimate of the expected credit loss must be unbiased and probability weighted. That means it has to be based on a probability and it should be unbiased. Discount to present value based on information about past event, current condition, focus of future economic condition. Receivable. See, receivable is also a financial asset. But the way we measure for receivable is different. It is not a investment in debt also. It's not no investment in equity. It's a financial asset, but it's not investment in equity also, investment in debt also. It is third category of financial asset. And the way we measure is different. That's why receivable is separately given. So the loss allowance should always be measured at an amount equal to lifetime credit loss for trade receivable that do not have a significant financing component. If you can recall my lecture 5, where I've discussed IFRS 15, receivable from long-term customers, from customer with contract. Okay, it's about revenue, sorry, revenue, not receivable, revenue from customer with contract. Then this was something which I've given in the last towards the end of my lecture. This part that I've told that loss allowance will be at equal to lifetime credit loss for trade receivable that do not have a significant financing component. There I have explained to you what is the meaning of trade receivable. Having significant financing component and not having significant financing component. In case you did not watch my that lecture, you can go now and watch it. Skip, pause the video, go back, IFRS 15, go towards the end and do watch it and come back to this. Okay, but shortly, let me tell you what does this mean, because I'm sure many of you did not understand what the trade receivable without significant financing component actually meant. It's easy for you to memorize, yes. If we do not have a significant component, loss allowance is lifetime. But what does it mean? And how will you identify whether it is having a financing component or not? It is about your prepayment and payment in accrual. If you are receiving anything has a prepayment, you have received in advance from your customer. It's like you have taken a loan from your customer. So it's a significant financing component which you have to pay back. If you are receiving an advance prepayment, okay, the revenue that you have recognized is more than the amount that you have to receive. Then you have to pay back the rest. And it's a prepayment. So that is the meaning of significant financing component. It's like you have taken a loan. That's why financing component. Okay. So that is the meaning of significant financing component. Okay. But if it's a payment and accrual, you are paying late, it is not a significant financing component. Then that trade receivable, you will recognize the loss allowance will be lifetime credit loss. Why? See, something, if you are paying a prepayment, if you are doing a prepayment, risk is less or more? Risk is less. Everyone wants prepayment. They want to be paid in advance. But the problem occurs when you're paying late. Payment in accrual is the riskiest area. That's why your loss allowance is equals to lifetime credit loss if you're paying late. If you're paying late means there is no financing component. If you're paying in advance, prepayment, it's a significant financing component. It's like you have taken a loan which you have to pay back. That's why. If you're not still not understanding, don't worry, the full calculation with full explanation is given. You can go back. But I'm sure with this explanation, you should be able to understand. Now, why is lifetime expected credit loss? Okay, so it's about you paying late or earlier. If you're paying later, risk is more. That's why lifetime. Now, derivatives. Derivative is not tested in financial reporting. For FR students, it's not tested, but it is there for SBR. So if FR students want, they can close the video and go to my next video, because after this point onwards, it is not relevant for FR students, but it is relevant for SBR students. So they have to watch this till the end. Okay. Derivatives is also one kind of financial instrument. We have finished financial asset liability. Now derivatives. Derivatives has to have this following three characteristics to say that it's a derivative. First characteristics. The value of the derivative changes according to interest rate, security price, commodity price, foreign exchange rate, or similar variable. The way derivatives react is based on these things. Okay, either the interest rate goes up, down, security price changes, foreign exchange rate. Okay, next, derivatives require little or no initial investment. Third, it is something to be settled at the future date. If these three criteria are met, it's a derivative. Okay, derivatives which are not part of a hedging arrangement will be classified as measured at fair value through profit and loss. If you are using derivatives for hedging, rules are different. But if you are not using for hedging, fair value through profit and loss. For derivatives, you do not have to worry fair value through OCI or amortize. It is everything fair value through profit and loss only. Okay. Now, coming to hedge accounting. Hedge accounting is an optional accounting treatment. Optional, not compulsory. When your gain and loss on the hedging instrument are recognized in the same performance settlement statement and in the same period as the offsetting gain or loss on the hedged items. There should be an hedged item, there should be a hedging instrument. Remember, if you are making a gain or a loss in the hedged item, there will be an opposite reaction in the hedging instrument. I'm sure you must have heard about options, forward, swap, future. These are hedging instruments. You are taking them to hedge your risk, to manage your foreign exchange risk. All these things are explained in detail in financial management or AFM. But details you do not have to know here in IFRS 9 for SBR and FR. But I'm just telling you what hedging actually does. Hedging actually manages your risk by taking a contract. It could be a future contract, option, swap, forward, money market. There are so many hedging instruments. Okay, why do you take that? To have a gain, of course. So if you're having a gain in the hedging instrument, you're going to have a loss in the hedged item. So the gain and the loss in the hedged item will be offset by the gain and the loss in the hedging instrument. If this relationship is there, then only you can use the hedge accounting. Okay, so in order to follow the hedge accounting rules, following criteria need to be met. First, the hedging relationship consists only of eligible hedging instruments and hedged item. I told you there should be a hedging relationship among the two. For example, if you are hedging using the instrument, it should actually reduce the risk. You should actually be able to manage the risk. If you are not able to manage the risk, there is no hedging relationship. And in the exam, they will often tell you whether hedging relationship is met or not, if hedging is required. At inception of the hedge, when you start the hedge, there should be a formal documentation that says this is the hedged item, this is the amount that you want to hedge, and this is a hedging instrument. For example, what is an hedged item? If it is a commodity price that you want to hedge, let's say in 3 months time your commodity price might rise, so that's why you are entering into a contract to fix the price of the oil at this price, so that even if the future rate goes later up or down, you will still buy the same rate. So that commodity price or foreign exchange is your hedged item. What is a hedging instrument? It is the forward or the future or the option or the swap that you're entering into. That is your hedging instrument. Now do you understand? And there's a documentation saying that you have entered into a contract to buy or sell so and so at this date. That is hedged item. Hedging relationship is effective. Now in the exam they will tell you that also. Hedging effect is ineffective or effective. It's effective, use hedge accounting. Ineffective, can't use hedge accounting. Okay. If the hedged item is a forecast transaction, then the transaction must be highly probable. Remember, you are entering into a hedging transaction only to hedge something that you are forecasting will happen. Okay, and it's highly probable also. For example, you are predicting exchange rate might go down, might be unfavorable. So it is something which is highly probable of happening. If it is highly unlikely probable of happening, then going to that hedging instrument is waste for you. It's a waste of money. Simply. Okay. Now, there are two types of hedge. One is known as fair value hedge. You want to hedge your fair value because fair value keeps changing up and down. You might be gaining sometime, you might be losing sometime. The other one is cash flow hedge. You might be receiving less or more cash. Okay. So in all this instrument that we have just gone through, financial asset, financial liability, debt instrument, equity instrument, there are two things. Either because it has to do with cash, either you're receiving more or less cash or paying less or more cash. That's why you have to hedge cash flow. Next, fair value changes. Fair value can change because finally it's an asset or a liability. So fair value will change. So that fair value is also a risk for you. You want to hedge it. So to hedge. First, let us finish with the fair value hedge. Okay. So at the reporting date, hedging instrument will be remeasured to fair value, like how we remeasure fair value under any standard. Hedging instrument also. The carrying amount of the hedged item will be adjusted for the change in the fair value since the inception of the hedge. So that amount that has been remeasured, you will adjust the carrying amount of the hedged item also when your fair value changes from the date when you have entered to the hedge. So there could be gain or loss, right? Fair value will go up and down. We don't know. So the gain or loss, see the word. The gain or loss. The gain or loss on the hedging instrument and the loss or the gain. It's not gain or loss and gain or loss. No. Gain or loss, loss or gain. That means one party is winning, one party is losing. One party is losing, other party is winning. It should have this opposite reaction. Equally opposite reaction. Plus 50 here, minus 50 there. Minus 50 here, plus 50 there. It's like that. That's how it works. Okay. So if you are having a gain in a hedging instrument, you should have a loss in a hedged item. You can't have gain in both area, nor you can have loss in both. Otherwise, hedging accounting will not work. There is no purpose for you to hedge your risk. You are hedging it so that loss in the hedged item will be offset by the gain in the hedging instrument. That's the whole purpose. Okay. So this will be recorded in profit and loss in most cases. But in other comprehensive income, if your hedged item is an investment in equity, that is measured at fair value through other comprehensive income. Please memorize the last line. Profit and loss, we all know it's a common scenario. If you remember where it goes in OCI, then it's very easy for you to know. If it does not fall in this, means everything else is profit and loss. Okay, that is investment in equity. If it is measured at fair value through OCI. Other than that, everything else goes to profit and loss. Simple. Now coming to cash flow hedge. So for cash flow hedge, the hedging instrument will be remeasured to fair value at the reporting date. Here also, it will be remeasured to fair value, the hedging instrument. So the gain and the loss is recognized in other comprehensive income. See, if it's fair value change will be recorded in profit and loss. But if it's a cash flow hedge, then the change in fair value will be recorded in the gain or loss due to change in the fair value will be recorded in other comprehensive income. But if the gain or the loss on the hedging instrument since the inception of the hedge is greater than the loss or the gain on the hedged item. Please understand this. If your gain on the hedging is more than the loss on your hedged item, where do you take the excess gain or loss? There is an excess amount. You see, they are not equal. If they are equal, there is no problem. Then that excess gain or loss, both gain or loss, okay, excess amount will be recognized in profit and loss. Okay, only to the amount equal. See, loss of hedged item and gain of hedging instrument, the equal amount 50-50 will be recorded in other comprehensive income, but anything excess beyond that will be recorded in profit and loss. This is for cash flow hedge. Okay, of course you have to do calculations and all which I have done in my IFRS 9 lecture. So these are the exam kit questions. With this, I've completed my IFRS 9 So DGY, Crypto, Aeron, Artright, Bismuth, Collide, Hummings. This is for SBR students. Make sure that you do these questions and take your own time to study IFRS 9. IFRS 9 requires more time compared to other standards because there are so many small areas and often questions are also lengthy enough. So make sure that you are able to follow through the questions. But before that, make sure that your concept is sound because without the strong concept in IFRS 9, you will not be able to do questions. So do not jump to the question straight away unless you do not understand financial asset, until you do not understand financial liability, until you do not understand investment in equity and investment in debt, how they are measured, at amortized, how it will be recorded, at fair value through OC, how it will be recorded, at fair value through profit and loss, how it will be recorded. Then the hedging instrument, that is cash flow hedge and fair value hedge. Until you do not understand this thing, do not go to a question. Okay. So thank you for watching. I shall see you in the next standard, that is IFRS 10, which is again for the consolidation purpose, which is applicable for your group accounting. Assalamu alaikum. Welcome to video 31. It's IFRS 10 Consolidated Financial Statement. Very relevant for both FR and SBR students because you will be asked a question on Consolidated Financial Statement. So definitely you have to apply the rules of IFRS 10. Now, IFRS 10 states that consolidated financial statement must be prepared if one company controls another company. That means you're owning more than 50%. So what is the definition of control? This is also an area which can be asked in both FR and SBR exam. For example, what constitutes controls? So there are three components. First, power over the investee. That means you are exercising through majority of the voting right. Next, exposure to variable returns. It could be positive, it could be negative. And ability to use the power. So it's not necessary that you have to use the power, but at least you have the ability to use that power. Okay, so these are the three things. If these three things are present, that means you are exercising a control. Normally, if you are owning more than half of the ordinary shares, that means more than 50%, you are having the control. You have to consolidate financial statements. Now, exam kit questions are Luploid, Banana, Colombia, Stem, Sterling, Luna, and Renshaw. This questions needs to be attempted. So that's it for IFRS 10. I shall see you in the next standard, IFRS 11, again, which is related to your group accounting. Assalamu alaikum. Welcome to video 32, IFRS 11 joint arrangement. This standard and the next standard, IFRS 12, are not in FR syllabus but is there in SBR syllabus. So a joint arrangement is a contract where two or more parties undertake an activity that is subject to joint control. So the meaning is it could be two or more than two. They are jointly controlling it. IFRS 11 says that joint arrangement can take one of the two forms. So IFRS 11, when you're applying, the main thing that you have to see is which of the two forms that you are taking, because the measurement then differs. Whether it's a joint operation or whether it's a joint venture. Joint operation means parties that have a joint control. Okay, they have right to the assets and the obligation for the liabilities. Normally, they are not a separate entity to conduct joint operation. Joint venture, they also have the joint control, but they have the right to the net asset and they are normally established in a form of a separate entity. So in joint operation, entity is not separate, but in joint venture, there's a separate entity that is created. Another difference is joint operation have right to assets and liability. Joint ventures have rights to net assets. Now, IFRS 11 requires, if it's a joint operation, you have to recognize the share of asset, liability, revenue, expense. And if it's a joint venture, you have to use equity method to account for it. Equity method I've covered under IS 28. So if it's a joint venture, you will follow IS 28 that we use for valuing associate. Because associates and joint ventures both use equity method. But if it's a joint operation, then you will use the rule of IFRS 11. You will just take the share of your asset, liability, revenue, expense. That's it. So thank you for watching and I shall see you in the next standard, again a very short standard, which is IFRS 12. Thank you. Assalamu alaikum. Welcome to video 33, IFRS 12, Disclosure of Interest in Other Entities. Again, a standard for group accounting, and this is the last standard for group accounting because there are so many standards which goes in group accounting. For example, IS 28, IFRS 11, IFRS 12, IFRS 3, IFRS 10. Now, this this is mostly about a disclosure. Okay, so you have to disclose when you're having an interest in subsidiary or joint arrangement or associates. So you can either have a control, joint control, or significant influence. IFRS 12 is designed to give relevant information to the users of financial statements. So you have to disclose details relating to the composition of the group, details of non-controlling interest within the group, identification and evaluation of the risks that are associated with any other interest held in other entities, which give rise to either control or joint control or significant influence. Thank you for watching, and I shall see you in the next standard, which is IFRS 13 Fair Value Measurement. So with this, now you are in a position to do attempt questions on group accounting because all the standards that are relevant for group accounting are over. That is IS 28, IFRS 10, IFRS 3, IFRS 11, and IFRS 12. Assalamu alaikum. Welcome to video 34. This is IFRS 13 Fair Value Measurement, applicable for both SBR and FR students. Objective of IFRS 13 is to provide a single source of guidance for fair value measurement. Note that IFRS 13 does not apply to two standards. One is IFRS 2 and the other one is IFRS 16. Fair value is the price that you would receive to sell an asset in a transaction between market participants at a measurement date. Now, in order to increase comparability between entities, IFRS 13 has established a hierarchy that categorizes input that is used when measuring fair value. There are three levels to measure the fair value. Level 1, Level 2, Level 3. Level 1 is when you are looking at an active market to get the prices. Usually they are quoted prices where you get a similar assets. You can say identical assets and liabilities. You take that price and that's the fair value. Level 2. Level 2, you might not get identical, but you get a similar prices. Okay. So when you get a similar prices, you have to adjust a price a little bit. Okay. Both for assets or liabilities. And also the prices for identical assets and liabilities where there is not an active market. Level 3, where there are no inputs for you to rely on. That means you have to estimate here in this level. And IFRS 13 is giving priority to level 1 over level 3. That means whenever you have to measure fair value, you have to go by this hierarchy. You have to give the priority to level 1 first. You should always look for the market which is giving you a similar, similar price for identical goods and service. If not, then level 2. Level 3 has to be a last resort when you're not having any prices information from the active market, not for identical, not for similar. Then you have to estimate. Why we are not prioritizing level 3? It is the most riskiest. Okay. Now, that's it for IFRS 13, and I shall see you in the next video, that is IFRS 15 revenue. Assalamu alaikum. Welcome to video 35, IFRS 15, which is revenue from contracts with customers. This is a major standard which is often asked in SBR and as well as FR. So IFRS 15 is also a standard which is 100% going to come for your exam. So in this standard, there are 5 steps to recognize revenue. First, you have to identify the contract. A contract is an agreement between two or more parties that creates rights and obligations. Second, identify the separate performance obligation within the contract. Performance obligations are promises that are made to a customer. Third, the transaction price. The transaction price is the amount that entity expects to receive in exchange for satisfying their performance obligation. Amounts that are collected on behalf of third parties, such as sales tax, are not transaction price. They are excluded. Fourth, allocate the transaction price to the performance obligations in the contract. If there are more than one performance obligation, transaction price you have to allocate between the performance obligation. And finally, you have to recognize revenue when you are satisfying the performance. So you can satisfy the performance over a period of time or at a point in time. If you are satisfying over a period of time, you will recognize the period over a period of time. And if it's at a point in time, you will recognize the point at a point in time. Okay. So for each performance obligation, it's very important to decide whether the performance obligation is satisfied over a time or at a point in time. Now, recognize revenue when you're satisfying. So this is for over a period of time. Okay, if one of the following criteria is met, you will recognize revenue over time. First, where the customer is simultaneously receiving and consuming the benefit as the entity performs. For example, right now what I'm doing, I'm teaching you. So as I'm teaching you, I'm receiving the benefit. So this is a service that I'm giving you. Okay, so when I recognize the revenue, I will recognize it over time. Second, entity performance will create or enhance the asset. For example, work in progress. Okay, any asset that takes a long period of time. Okay, so while they're in the work in progress, you will recognize the revenue to the portion how much they've covered. For example, I've covered 60% of my work. So the revenue also I can recognize only up to 60%. One example is creation of building. When you construct a building, so as long as you start working on it, it will enhance the use of their asset. Okay. Third, entity performance does not create an asset with an alternative use. There is not an alternative use. You cannot sell it to another party. Okay. Entity has an enforceable right to payment for performance completed to date. Okay. So entity will have the right to receive the payment to whatever work they have completed. If they, let's say they have completed 60% of work, so they will get the 60% of amount, which they will recognize as revenue. So any of this criteria is met, your performance obligation is satisfied over a period of time. Therefore, your recognized period also over a period of time. Coming to performance obligation that is satisfied at a point in time. Okay, so you are recognized at a point in time. This is easy. This is when the control passes to the customer. And mostly for goods, it is performance obligation at a point in time, and for services, it is over a period of time. So for at a point in time, the most important is you have to see the date when customer is obtaining the control of the good. Now, let us go through an example. So A company is entering into a contract with B to construct a building. Construction started on 1st October. The contract price was 4 million plus a bonus of 1 million that would be payable if construction is completed by 30th September. Building has been specially designed for B and it cannot be sold to any another entity without modification. A believes that it is more likely than not that they will meet the bonus criteria. Okay. Now, so the terms of the contract specify that B must pay A within 30 days of the end of each quarter based on the progress. A measures their progress as a proportion of total estimated contract cost. So the total cost is 2.5. If B cancels the contract, it is liable to pay A for the work they have completed. So by 31st December, A has incurred cost of 0.5. So the estimate of the total cost will remain unchanged here for the contract. Although the progress on the contract has been satisfactory, there is still doubt whether that 1 million bonus will be received or not. Okay. Now, so what is the accounting treatment? A has entered into a contract with a customer. Okay, it's very clear that there is a contract that they have entered with a single performance obligation. What is the performance obligation? To construct a building. Price is also fixed, the transaction price, which is 4 million. 4 million is a fixed consideration, 1 million is a variable consideration, that bonus part. But the variable consideration you can only include in your transaction price if it is highly probable that it will not be reversed once the uncertainty is known. So due to the bespoke nature, you see the nature of the building is very unique. So there are doubts. So because there are doubts, variable consideration that 1 million should be excluded from the transaction price. You cannot take it as a part of transaction price. So your transaction price will remain at 4 million only. Okay. Now, revenue. Let us come to the fifth stage, recognition of revenue. So we have identified the contract, we have identified the performance obligation, we have allocated the transaction price, we have allocated the transaction price to the performance obligation. Now the last stage, recognition of revenue. So the revenue should be recognized over a period of time or at a point in time. Over a period of time. This is a construction of building, it takes a time. Okay. So A is creating an asset with no alternative use. It has right to payment for performance completed to date. Therefore, according to IFRS 15, they will record it over time. So the amount you have to write. So for performance that is satisfied over time, revenue is recognized based on the progress. Okay. So it is 0.5 divided by 2.5, the total cost of the contract versus 0.5, which is 20%. So you will recognize only 20% of the 4 million. That is your transaction price. So 0.8 million. This is your revenue. So A has to show a corresponding receivable of 0.8 because it has an unconditional right to receive this money. Okay. Now, example of a non-refundable deposit. So Flight is an airline which sells flights directly to customers via a website. Flight must pay for in full at the time of booking and flights are non-refundable. So what happened here? Flight has entered into a contract with a customer. That is single performance obligation, that is to provide a flight. And in this case, it is satisfied at a point in time when the flight has been taken. So they will recognize once the flight has been taken by the customer. Now, from the exam kit questions, these are the questions you have to do: ZTech, Cartoon, Sitka, Jassy, Rubel, and Calibra. Thank you for watching, and I shall see you in the next video, that is IFRS 16 Leases. Assalamu alaikum. Welcome to video 36, IFRS 16 Leases. Now, leases is applicable for both SBR and FR students. First, you have to identify a lease. So lessees are the one who has taken a lease. Okay, lessor is the one who has given the lease to the lessee. So the lessee have to recognize two things: one, the right to use that asset; second, liability because they have taken a lease. So they have to recognize asset and liability for all the leases unless the lease is for short term or it's of a minimal value. So it is vital to assess whether a contract contains a lease or whether it is simply a contract for service. If it's a contract for service, you have to apply the rule of IFRS 15, that is revenue from contract with customer. If the contract contains a lease, then you have to apply the rule of IFRS 16. A contract contains a lease if it conveys the right to control the use of an asset for a period of time in exchange for a consideration. Lessee accounting. So in lessee accounting, if the lease is short term, that means less than 12 months, or of a low value, lessee can choose to recognize the lease payment in the profit and loss as an expense. Okay. In all other cases, IFRS 16 requires the lessee to recognize lease liability and the right of use asset. So the asset that they recognize for using that asset is known as right of use asset. Okay, and lease liability when you start the lease. Now, the right of use asset, initially it is measured at cost. So the initial value, how are you going to measure the lease asset? The initial value of your lease liability, of course, the amount that you have to pay will be your asset also. But with that, you have to add any lease payment made at or before starting of the lease, as well as any guided cost. The right of use asset, like any asset, will subsequently be depreciated. So cost less accumulated depreciation and impairment loss. Unless another measurement model is chosen. For example, you are revaluing it. But usually they will not give you revaluation for right of use asset. When it is leases, it is at cost. Lease liability is initially measured as the present value of the lease payment that have not been paid. Usually they will give you the amount. You don't have to discount or find the present value. They will give you the present value of the lease payment. So you can take the figure as it is. The carrying amount of that lease liability will be increased by the interest charge, because any liability, interest also will be charged, and interest is added to the amount, just like loan. Same for lease liability also. It will be increased by the interest charge, which will be recorded in the statement of profit and loss. Any cash repayment that you are doing will reduce your carrying amount of the lease liability. Same like how loan works. Okay. Now, lessor accounting. So one side we have lessee accounting, who has taken the lease. They will record right of use asset or lease liability. On the other hand, the one who is giving you the lease, lessor, is known as lessor. Lessor accounting, they will recognize either a finance lease or an operating lease. What is a finance lease? A finance lease means the risk and the rewards of the ownership is transferred to the lessee. And the operating lease means risk and ownership does not transfer to the lessee, it remains with the lessor. Okay. So let's first understand some key indicators of a finance lease. They are: ownership of the asset transfers to the lessee at the end of the lease term. Lessee has an option to purchase the asset at the end of the lease term or to continue to lease it for less than the fair value. Lease term is the major part of the asset's economic life. The present value of the lease payment is the substantially all of the asset's fair value. So if this condition things are there, it's a finance lease. Now, if the lease is a finance lease, the lessor will de-recognize the asset. Why? They have given the asset to the lessee. Lessee has taken the ownership of the asset. So why will lessor recognize the asset any longer, right? They will de-recognize the asset. Rather, they will recognize a lease receivable, because they are going to get that amount from lessee. So lease receivable, which will be equal to the net investment of the lease. That is the present value of the payment. They will recognize an interest income also that will arise on the lease receivable, which will be recorded in profit and loss. If the lease is an operating lease, lessor will continue to recognize the asset. Okay, so they will recognize the lease income in the profit and loss over the lease term. Now, sale and lease back. This is also a very common scenario which is often tested. That is, when you first sell the asset and then you're using the asset as a lease back. So you're not owning the asset any longer. You are selling it and then you're using it under lease. So in this case, you have to see the transaction whether it represents sale or not. If it is a sale, you have to use the rule of IFRS 15. And if it is not a sale, then we'll see. So this table will help you a lot. Transfer is a sale, transfer is not a sale. So if the transfer is not a sale, from the lessee's point of view, how they will recognize, and from the buyer, who is the lessor, how they will recognize. Okay. If it's not a sale, lessee will continue, the seller is the lessee here, okay? They will continue to recognize the asset because it's not a sale. So they will recognize what? A financial liability. Why? Because they have to pay now. See, it's a seller, lessee, right? They have sold and they are leasing back. When they lease back, they are taking the lease. So they have to pay that amount. So for them, it's a financial liability. They have an obligation to pay to the lessor, to the buyer. So they will recognize a financial liability equal to the proceed that they have received from selling, which is not a sale. So that proceed that they have received is equal to the financial liability. On the other hand, lessor, they will not recognize the asset because it's not a sale. We have now sold them to the lessor. They will recognize a financial asset equal to the transfer proceed. So lessee will recognize financial liability. Lessor, they will recognize financial asset because they have the right to receive that amount from the lessee. This is when it's not a sale. But if it's a sale, seller, the lessee will de-recognize the asset and they will recognize a right of use asset. But here, complication arrives here. When you recognize a right of use asset, it's not the full amount. It is the proportion of the asset's previous carrying amount that relates to the rights that is retained. Of course, the amount that is not retained, how can you recognize it? You will only recognize to the rights that you are retained. Recognize a lease liability. Lease liability, not financial, lease liability, because it's a sale. Because now you have taken a lease. So it's a lease liability for you. And because it's a sale, profit and loss will come. So that profit and loss will arise on disposal. Buyer, on the other hand, they have purchased that asset from the lessee. So they will account for the asset purchase. They will account for the lease by applying the lesser accounting treatment. That means for them, it could be a finance lease if they have taken the control at the end of the lease, or a operating lease if they have not taken the ownership. Now, let's go through this example. So N is selling a property to F for 20. Property has a carrying amount at the date of disposal of 7. N enters into a contract to lease the property back from F for 5 years. Present value is 5.7. Now, if the sale and the leaseback transaction represents the satisfaction of performance obligation in accordance with IFRS 15, that means it's a sale. N, who is the lessee, has to recognize a right of use asset at the proportion of the asset's previous carrying amount that relates to the rights retained. Okay, so this is how you get it. Assets previous carrying amount. So what is the previous carrying amount? The present value of the lease payment is 5.7. That is the present value of the lease payment. They are selling the property for 20. So 5.7 over 20 into 7. This 7 is the property at a carrying amount. So right of use asset will be recognized at 2 million. This proportion you have to know. Okay. So a lease liability will be recognized for the present value of the lease payment, that is 5.7 already given to you. But right of use asset you will recognize at 2 million. Now, so the double entry, debit cash 20, because you're selling, you are receiving the cash, and you have to debit the right of use asset because it's a sale and you have taken it under lease, so 2 million, and then you have to credit the lease liability 5.7, and also you have to credit property, plant and equipment because you are selling it, the carrying amount, that is 7 million, and you have to credit the profit on disposal. Remember, that is this is a balancing figure. Your debit side has to always balance your credit side. So it's the profit on disposal because the balance came on the credit side. Okay, 9.3. Now, if the sale and the leaseback transaction does not represent a sale, then N will continue to recognize the asset within his BP and will recognize a financial liability for the proceeds that they have received, which is 20 million. Okay. Now, these are the exam kit questions that you have to do. That is Laria, Crypto, Anok, Cherry, STEM, and Bohai. So thank you for watching, and with this I've finished almost all the standards. Now it's your job to do all the questions from all the standards from your revision kit as well as some past papers for both FR and SBS students. Thank you for watching.